Please like, share, and subscribe. Wishing you happiness and good luck every day.
What if I told you there's a simple, almost foolproof way to guarantee you get your fair share of whatever the stock market returns? Seriously, it's not some get-rich-quick scheme, but a truly revolutionary idea from this book right here. John Bogle's The Little Book of Common Sense Investing. So let's get into it. We're going to unpack one of the most powerful and most common sense ideas in all of finance.
And hey, you don't have to take my word for it. Just listen to Warren Buffett, probably the most successful investor of all time. This quote right here, it basically gives away the entire plot of the book. And it's the absolute core of what we're talking about today. The incredible power of just owning the whole market through a simple, low-cost index fund. Now, to really get why this idea is such a game changer, we have to start where Bogle starts, and that's from a really optimistic place. He calls investing a winner's game, and it's all based on the simple and honestly often overlooked power of just owning businesses. Okay, let's break that down. What Bogle's saying is that when you own stocks, you're not just playing with numbers on a screen. You're an owner. You own a tiny slice of real companies, and over the long haul, those companies, driven by human ingenuity, innovation, productivity, they create real, actual wealth. The whole economic pie gets bigger. That means it's a positive-sum game for the people who own the pie. And this isn't just some nice-sounding theory. Check out the numbers. Bogle points out that over the last 100 years or so, U.S. corporations have generated an average annual return of 9.5% on their capital. That is the engine. That's the wealth creation machine that, as an owner, you get to tap into. And this is where the real magic kicks in. You take a return like that and you combine it with time, and you get the miracle of compounding. Look at this. $1 turns into almost $2.50 in 10 years. Okay, cool, but just watch how it accelerates. After 50 years, that same dollar bill is worth over $93. It's just an incredible illustration of what happens when you just own a piece of the economy and let time do all the heavy lifting for you. All right, so here's the big question, the paradox at the heart of it all. If owning businesses is such a clear winner's game, why isn't every investor rich? Well, Bogle has this powerful metaphor he calls the croupier's cut. And it explains exactly how this beautiful winner's game gets turned into a loser's game for most people. This is it. This is the central mystery of the book. We've just seen that businesses are out there creating enormous value year in and year out. So what's going wrong? Where's the disconnect between the company's success and the average investor's account statement? Where does all that money go? Bogle's answer comes down to what he calls the relentless rules of humble arithmetic. So think about it like this. Before you factor in any costs, trying to beat the market is a zero-sum game. For every single person who outperforms the average, someone else has to underperform by that same amount. It's just simple math. But look at the right side. The second you introduce costs, fees, commissions, anything, the whole game changes. For investors as a group, it becomes a guaranteed loser's game. So who are these croupiers in Bogle's Wall Street casino? Well, they're all the middlemen who are taking a slice of your money. Here are the usual suspects: management fees, trading commissions, all those hidden operational costs. And the most important part, the croupiers always get paid whether your investments go up or down. They're the house, and we all know in the long run, the house always wins. And this is the absolutely devastating flip side to that compounding magic we saw earlier. Just like returns compound for you, costs compound against you. It's a tyranny. A seemingly small 2% fee doesn't just reduce your return by 2% each year. Over decades, it can literally consume more than half, sometimes 2/3 of your potential nest egg. It is a tyrannical force that is quietly eating your future. So why on earth would so many of us willingly pay these high costs? Why do we keep playing this rigged game? Well, it's because we've all been sold on what Bogle calls the grand illusion. This deep-seated belief that we or someone we hire can consistently and successfully beat the market. This is the little voice in our heads that gets us into trouble. We all like to think we're a little bit smarter than average, right? That we can spot the next Apple, or that we can find that one genius fund manager who can see the future. Bogle just lays out piles and piles of data to show that for the vast majority of us, this is a really dangerous and incredibly expensive illusion. And look, this isn't just an opinion.
Let's look at the actual data Bogle shows us. In one study, the most hyperactive traders, their stocks had a gross return of 17.9%. That sounds fantastic, right? But hold on. The cost of all that frantic buying and selling, a whopping 6.5% in trading costs. That chopped their actual take-home return all the way down to 11.4%. They literally gave away over a third of their potential gains just by trying too hard. And if you think Bogle is being a little too harsh, just listen to this. This is a brutally honest quote from Charlie Munger, Warren Buffett's partner. He says that after you subtract all the fees, the entire active investment management industry as a whole adds absolutely zero value. Zero. It's a staggering thing to hear from one of the titans of the industry.
Okay, so we've laid out the problem, and yeah, it can sound a little bleak. But this is where the story turns, because Bogle doesn't just identify the problem. He gives us a simple, elegant, and unbelievably powerful solution. Let's talk about how to get out of the loser's game and join the revolution. And here it is. This is the hero of the story, the classic index fund. The design is just beautifully simple. An index is just a list of stocks that represents the market, like the S&P 500, which is just the 500 biggest U.S. companies. An index fund does something radical. It just buys all the stocks on that list and then holds on to them for you at the lowest possible cost. It doesn't try to pick winners, it just buys the entire market. You know, the real genius of the index fund isn't just what it does, it's what it eliminates. Think about what you no longer have to worry about. You eliminate the risk that your one big stock pick goes to zero. You eliminate the risk of being in the wrong industry at the wrong time. And maybe most importantly, you eliminate the risk of picking that star fund manager right before their magic touch disappears. The only risk you have left is the one you can't escape anyway, the risk of the stock market itself. And this is probably the best metaphor in the entire book. The old way of doing things, the loser's game, is like trying to find one specific winning needle in a giant haystack. It's incredibly hard, it's time-consuming, and it's really expensive. The index fund, the winner's game, has a much simpler idea. It just says, forget about looking for the needle, just buy the whole haystack. So let's bring this all home. The goal is no longer to try and beat the market, which we've seen is a fool's errand for most people. The new goal is just to capture the return that the market itself generates. By owning the entire haystack, you are mathematically guaranteed to get your fair share of business returns, minus a tiny, tiny cost. And Bogle just boils his entire philosophy down into these 3 simple, doable steps. First, buy a fund that owns the whole market, and make sure, absolutely sure, it's low cost. Second, do nothing. Just hold on, through the good times and the bad, forever. And third, stop playing the game. Turn off the financial news, stop checking your portfolio every day, get out of the casino, and let your businesses do the work for you. And again, it's not just Bogle saying this, it's not some fringe idea. Here's another respected voice, William Bernstein, saying the exact same thing. The best way to avoid all those problems we talked about? Just buy a well-run index fund and own the whole market. It's that simple. And I think that's the key takeaway. Bogle's revolutionary strategy isn't based on some fancy algorithm or a secret crystal ball. It's grounded in something way more powerful and reliable, just pure common sense and those simple, undeniable, relentless rules of humble arithmetic. And that really brings us to the end. Bogle lays out the case so clearly. The economy itself is a winner's game, but the investment industry has turned it into a loser's game for most of us. He's given us the playbook for how to opt out of all that. So the only real question left is the one on your screen. The math is clear. So will you choose to play the winner's game?
Okay, so let's dive into a really simple story, a parable that Warren Buffett loves to tell. And it's brilliant because it cuts through all the noise, all the complexity of the financial world to show us a huge kind of shocking truth about investing. It's the story of a family called the Gottrocks. So think about this for a second. It sounds totally backward, right? We live in a world that's always yelling, do something, make a move. But what if the most powerful, most effective strategy was actually to just do nothing? Just stand there. Keep that crazy idea in your head as we get into this. All right, let's set the stage. Our story starts with this extremely wealthy family, the Gottrocks. And in the beginning, for them, investing was a super simple, can't-lose kind of game. I want you to really picture this perfect setup. The Gottrocks family literally owns all of corporate America. I mean every single share of every company. So what does that mean? It means they get all the profits. Every dividend check that gets mailed out, all the money that companies reinvest to grow bigger, it all flows to them. They own the entire economic engine of the country. So you can think of it like this, right? All the money generated by U.S. businesses is a giant pie. And in the beginning, that entire pie, 100% of it, belongs to the Gottrocks family. There are no other slices. Nobody else is taking a cut. It's a perfect system where everyone in the family gets richer at the exact same speed as the market itself. But you know how these stories go. This perfect, simple harmony? Yeah, it wasn't going to last. The whole thing was about to get a lot more complicated because a new group of people showed up. They were called the helpers. And in come these helpers. They're slick, they're persuasive, and they go to some of the Gottrocks family members and whisper this really tempting idea in their ear. Hey, why are you settling for the average return? We can help you get a bigger slice of the pie than the rest of your family. The whole sales pitch is that by actively trading, by picking winners and selling losers, they can outsmart everybody else. And this is where things start to get expensive. It starts with one layer. First, you've got the brokers who charge a commission on every single trade. Then, when that doesn't really work out, the family hires money managers, another layer of helpers who charge a hefty fee for their so-called expert advice. And when that fails to beat the market, oh, you guessed it, they bring in consultants to help them pick the right managers. See what's happening? Every new layer of help just adds another layer of fees. So, with all this activity, all this wheeling and dealing and all these fees, what do you think happens? You got it. The family's pie, the one that used to be whole, it starts to shrink. Let's take a look at the real cost of all this help. And this is how the money just starts bleeding out. It's like death by 1,000 cuts. Commissions are going out the door to the brokers. Big management fees are going to the managers and the consultants. And on top of all of that, all this frantic buying and selling is creating a huge tax bill from capital gains, a bill the family never ever had to pay when they just owned everything. So look at the pie now. It's not whole anymore, is it? The helpers, well, they've carved out a nice big slice for themselves with all their fees and commissions. And the government, it's taken its piece in taxes too. Every single sliver that goes to an outsider is a sliver that's taken directly out of the Gottrocks family pockets. Finally, after all this expert help, the family sits down and does the math. And what they find is just stunning. That 100% share of the pie they started with, it's now down to just 60%. Let that sink in. 40% of their potential wealth is just, poof, gone, gobbled up by the very people who promised to make them richer. Right when it seems like a total disaster, the family has a sudden moment of clarity, a wake-up call, and it comes from the wisest member of the family. This is the simple idea that changes absolutely everything. The wise uncle sees exactly what's going on, and he just cuts right through all the noise. His advice isn't some complex financial formula. Nope, it's brutally, beautifully simple. He tells them to fire everybody. Get rid of all the helpers who have been draining the family's wealth. And his logic? It's just airtight. He's basically saying, guys, what are you doing? Go back to what worked. Go back to that boring, passive, but incredibly powerful strategy of just owning everything and doing nothing. Stop trying to outsmart each other, because the only people winning this game are the helpers. If you just stand pat, you get to keep 100% of the pie again. And just like that, the family figured it out. But here's the thing. This isn't just some cute little story. It's a dead-on parable for how investing works in the real world, for real people like you and me. So you're probably wondering, okay, so what's the real-world version of the wise uncle's advice? Well, it has a name. It's called the index fund. An index fund does exactly what the Gottrocks family should have been doing all along. It just buys all the stocks in a market, like the S&P 500, and holds on. It is the ultimate stand-pat strategy. And this gets to the very heart of the problem, a fundamental conflict of interest in the entire investment industry. The business of finance makes its money by encouraging you to trade, by telling you, don't just stand there, do something. But for you, the actual investor, the path to building real wealth is usually the complete opposite. Don't do something, just stand there. And who better to sum this all up than Warren Buffett himself? It's almost like a law of physics for finance. The more you move your money around, the more motion you create, the more you pay in fees and taxes. And the more you pay out, the lower your actual returns are going to be. It's that simple. Now, look, you don't have to just take my word for it, or even Buffett's. let's see what some of the other sharpest minds in the world of finance have to say about this exact same idea. Okay, this quote is a bombshell. It's from Jack Meyer, the guy who was in charge of Harvard's massive multi-billion-dollar endowment fund. And he does not mince words. He calls the investment business a giant scam. And why would he say that? Because the numbers don't lie. Somewhere between 85 and 90% of professional money managers, the experts, fail to even match the market's return once you factor in the fees they charge. So what does this legendary investor tell regular people like us to do? Well, it's going to sound really familiar. It's the wise uncle's advice, just broken into 3 steps. 1. Get diversified. 2. Keep your fees as low as humanly possible, using low-cost index funds. And 3. Invest for the long haul. That's it. That's the formula. And it's not just the pros who figured this out. The academic world is totally on board. Professor Burton Malkiel from Princeton basically says the evidence is overwhelming. It's conclusive. If you just buy an index fund, you are statistically more likely to end up with better results than the person who pays high fees to a typical professional manager. So, it all boils down to this one simple, common sense idea. Successful investing isn't about finding a needle in a haystack. It's about buying the whole haystack. When you own the businesses and you cut out the middlemen, you get to keep the biggest possible share of the returns for yourself. It really is that simple. And that brings us right back to you. The financial world is absolutely full of helpers promising they can get you an edge, that they can find you a bigger slice of that pie. But now you've heard the wise uncle's advice, and you know it's backed up by legendary investors and decades of data. So the choice really is yours.
Today, we're tackling a big idea called rational exuberance. We're going to figure out how to win the real game of investing. And spoiler alert, it has almost nothing to do with what you see on the news every day. You know, if you've ever turned on a financial news channel, this quote from Shakespeare probably feels, well, pretty spot on, right? It's just this constant frenzy of ups and downs, experts yelling, breaking news alerts. It feels chaotic, totally confusing, and maybe, just maybe, it doesn't really mean all that much. But what if there's a much simpler, way more powerful reality hiding underneath all of that noise? So here's our game plan. First, we're going to expose the market's biggest distraction. Then we'll get to the heart of the matter, where returns actually come from. We'll decode the 2 main forces at play here and look at a century's worth of proof. And then we'll learn how to deal with the market's crazy mood swings. And finally, lay out the simple rules for what we can call the winner's game. All right, first things first, we need to understand the core problem, the thing that trips up so many people. And that is the market's grand distraction. Here's the thing. The stock market, with its flashing numbers and daily drama, it makes us focus on what other people think stocks are worth at any given second. It's a game of guessing what everyone else is going to guess. But all of that, it's a huge distraction from the real engine of wealth creation, which is the slow, steady, sometimes even boring profit being generated by actual businesses. You know, companies that are making things and selling them. So, if the daily market is just a distraction, where should we be looking? Well, this brings us to the single most important idea we're going to talk about. Business reality is king. Warren Buffett just nails it with this quote. I mean, think about it. It's pure logic. In the long run, the total amount of money available for all shareholders to split comes from one place and one place only: the profits that the business itself earns. Stock prices can do a wild dance around that fundamental truth for a while, sometimes for years, but eventually they always have to come back home to reality. Okay, so let's put this to the test. Let's not just talk about it, let's look at the hard data. If we go back over a 106-year period and measure only the returns that the businesses themselves generated, we're talking their earnings growth plus the dividends they paid out to owners, what do you think that number was per year? The answer is 9.5% a year. Now remember, this is what we call the investment return. It's the pure, fundamental performance of American business, totally stripped of any stock market hype or speculation. All right, so we've got the business reality, 9.5%. Now for the million-dollar question. What was the actual total return you got from owning the stock market over that exact same 106-year period? This includes all the bubbles, all the crashes, all the greed, all the fear, the whole shebang. It was 9.6%. Just let that sink in for a second. Over more than a century, the two numbers are practically identical. All that sound and fury we talked about, all the speculation, the panic selling, the euphoric buying, it all amounted to a rounding error of 0.1%. This is stunning proof that over the long term, the The market's return is almost entirely driven by the real returns of its businesses. So how is that even possible? How can something so chaotic end up so predictable? Well, to get it, we need to break down the two engines that power the stock market, what we call the investment return and the speculative return. Think of it like this. On one side, you've got the investment return. This is the real market. It's powered by real things like how much a company's earnings grow and the dividends it pays out. It's all about corporate performance. But then you have the other side, the speculative return. This is the expectations market. It has nothing to do with business results and everything to do with emotion and psychology. Basically, how much people are willing to pay for $1 of those earnings, which we measure with something called the P/E ratio. And look, this isn't just some abstract theory. The historical data paints an unbelievably clear picture of how these two forces behave over time. Let's actually look at the evidence, decade by decade. So first up, here's the investment return, the real business return. Look at how steady this is. Decade after decade, it's almost always positive, chugging along. This is that solid foundation, that 9.5% average return, built on the slow and steady growth of American business. It's the bedrock. Now, hold on to your hats. Here's the speculative return. Yikes. It's a total emotional roller coaster, right? You see these massive spikes of euphoria, like the Roaring '20s or the '90s dot-com bubble, followed by these soul-crushing crashes. What speculation gives with one hand, it tends to take away with the other. This is a classic pattern called reversion to the mean. Things get too crazy and they snap back. I mean, this contrast says it all, doesn't it? In the short run, investing feels like you're lost in a stormy sea of emotions. But when you zoom out and look at the big picture, you see that the whole journey is guided by this slow, powerful, steady current of economics. The short-term emotions, they just dissolve into the background. Okay, so if the market's day-to-day moves are just emotional noise, how are we supposed to deal with it? How should we react? For that, we turn to a timeless lesson from the father of value investing himself, Benjamin Graham. Graham gave us this brilliant analogy. He said, in the short run, the market is basically a popularity contest, a voting machine. It's all about fads, emotions, what's hot right now. But in the long run, it becomes a weighing machine. It stops caring about popularity and starts assessing the actual substance, the real value of the underlying business. Your job as an investor is to focus on the weight, not the votes. To make this crystal clear, Graham actually invented a character. He called him Mr. Market. Imagine Mr. Market is your business partner, and every single day he shows up at your door. Some days he's euphoric, he's manic, and he offers to buy your shares from you for a ridiculously high price. But other days he's deeply depressed and terrified, and he offers to sell you his shares for pennies on the dollar. And here is Graham's whole point. You would never let your moody partner, Mr. Market, tell you what your business is actually worth. You know its real value. So you don't have to trade with him. You can happily ignore his silly offers and just pay attention to how your business is actually doing. Its profits, its dividends. You can use Mr. Market when he offers you a bargain, but you should never, ever take his advice. Okay, this brings us home. Let's put this all together and figure out how to play what John Bogle called the winner's game. And the secret is focusing only on the things you can actually control. It really boils down to this simple but incredibly powerful framework. Number one, you have to consciously decide to ignore the short-term noise, all those votes from the voting machine. Two, you choose to invest in the real market of business, not the expectations market of speculators. And how do you do that? With steps 3 and 4. You pay attention to the real results, the dividends coming in, and the operating performance of the businesses you own. That's it. That's the whole game. And so, we'll leave you with this final question to think about. Now that we know that real, lasting wealth comes from the performance of actual businesses, not the fleeting emotions of the crowd, what game are you playing? Are you acting like a business owner focused on long-term results? Or are you acting like a speculator, just trying to outguess the moods of Mr. Market? The answer to that question will likely determine your entire investing journey.
Today, we're going to tackle the stock market. But let's forget all the complicated strategies, all the jargon, all the noise you see on TV. We're going to cut right through all of it to find a simple, incredibly powerful truth, how to just align yourself with business itself and play the investment game to actually win. All right, so here's our roadmap for today. We're going to start with the big problem every investor has to grapple with. Then, we'll introduce a super simple solution and dig into what the market even is. After that, we'll pit this simple idea against the experts and look at the hard data. We'll even check out some real-world proof of how it works and wrap it all up with a conclusion that is just pure common sense.
So let's jump right in. At the very heart of investing, there's a fundamental dilemma. And it really all boils down to one single, incredibly important question you have to ask yourself.
I mean, really think about that. Are you out there trying to beat everybody else, playing a winner-take-all game of picking the perfect stocks at the perfect time? Or is there a completely different game you could be playing? A game where you're not trying to beat anyone, but instead you're just trying to capture the success of business as a whole. How you answer that question changes everything.
So how do we solve this big dilemma? Well, believe it or not, the answer comes from this brilliant 700-year-old idea that just slices right through all the financial complexity we see today.
It's called Occam's razor. And yeah, it's a principle from science, but its wisdom is universal. It basically says that when you're looking at a problem and there are a bunch of different complicated solutions, the simplest explanation is almost always the right one. In other words, don't overcomplicate things. And here it is. This is Occam's razor applied directly to investing. The simplest solution isn't trying to find some secret stock-picking formula. It's just to own the market. You buy a small slice of every public company in the US and you just hold on. That's it. It's a simple act that guarantees you win the very game that most other investors are mathematically doomed to lose.
Okay, so this idea of owning every business sounds pretty cool, right? But how in the world do you actually do it? I mean, you can't exactly call up 5,000 different CEOs. Well, luckily, you don't have to. There are some really simple tools that do it all for you. Let's break them down.
Here are the two main ways to do it. First, you've got the classic, the S&P 500. This tracks the 500 biggest companies in the US, and that covers about 80% of the entire market's value. Then you've got the total stock market index, and just like it sounds, this one tries to own the whole shebang. All 5,000 or so publicly traded companies.
Now here's where it gets really interesting. Let's look under the hood. Now the names at the top change from year to year, but the principle is always the same. Because these indexes are weighted by size, the biggest companies totally dominate both of them. See, the top 500 companies make up 100% of the S&P 500, right? But they also make up over 80% of the total stock market index. Their investment DNA is just remarkably similar.
Okay, so let's get to the main event. How does this super simple strategy of just owning the market stack up against the professionals? You know, the experts whose entire job is to try and beat the market. Well, given how similar they are, it's probably not a huge shock that their performance over the long run is nearly identical. I mean, look at this chart. For almost a century, their returns have moved in near-perfect lockstep. The lines are practically indistinguishable. It tells you that whether you own the top 500 stocks or all of them, the journey ends up being pretty much the same. And this number right here just hammers the point home, a correlation of 0.98. In statistics, that is about as close to a perfect match as you can possibly get. What it really means is that for a long-term investor, choosing between these two has made almost no difference. The key was just owning one of them. And this all leads to a really crucial point. Owning the market is a winner's game. But trying to beat the market, that's a loser's game. Think about it. By definition, all investors as a group have to earn the market's return. But that's before you subtract all the costs of playing. The fees, the commissions, the taxes. Once you take those out, the average investor who's trying to get clever must underperform the market. It's just simple, inescapable arithmetic. And the historical data just proves it, time and time again. Check this out. In one study, over 35 years, the simple, boring S&P 500 index beat the average actively managed fund in 26 of those years. The so-called experts only won 9 times. I mean, the deck is just overwhelmingly stacked in favor of the simple index. You see, the superpower of an index fund isn't some kind of genius strategy. It's just consistency. It never hits a grand slam, but it also never strikes out. It just reliably delivers whatever the market gives year after year. And over the long run, that relentless consistency will absolutely crush the roller coaster ride of a fund that's brilliant one year and a total disaster the next.
Okay, let's make this really tangible. Let's forget the charts and percentages for a second and look at a real-world story of what this simple, almost boring strategy could have actually accomplished for someone.
So just imagine an investor putting $15,000 into the very first S&P 500 index fund ever created. The year is 1976. They make this one investment, and then they do the absolute hardest part of investing. Nothing. They just hold it. For 3 decades. Through all the market crashes, the booms, the recessions, the bubbles, everything.
30 years later, by 2006, that initial 15 grand had grown to over $460,000. And you know what? If they'd just kept holding it, today it would be worth millions. That right there is the incredible, life-changing power of simply owning a piece of the economy and letting compounding do all the heavy lifting for you.
Now look, this isn't some obscure theory I'm cooking up. This common-sense approach is championed by some of the most brilliant and respected minds in the entire world of finance.
I mean, just listen to the late David Swensen. This guy was a legend who managed Yale's massive endowment. He doesn't pull any punches. He calls the underperformance of other funds wealth-destroying. He's saying it's not just that the experts fail to win, their attempts to win actively cost their investors enormous amounts of money.
And this same idea is echoed across the Atlantic. Jonathan Davis points to a professional omerta, like a code of silence, inside the financial industry. He's suggesting that the experts know how powerful this simple strategy is, but it often goes unmentioned because, well, complexity is just more profitable for them.
So, it all comes back to this one simple choice. You can play the loser's game, it's complex, it's expensive, and it's a mathematical certainty that as a group, investors playing it will fail. Or you can play the winner's game. It's simple, it's low cost, and it guarantees that you capture your fair share of all the growth that businesses generate over time. You get to decide which game you play. And we'll just end with this one thought to ponder. The evidence is clear. The math is simple. The logic is totally sound. So the real question isn't about which strategy works better. The real question is, why is there an entire multi-trillion-dollar industry built on spending billions of dollars to convince you to do something else?
Have you ever wondered why, even though the stock market is this incredible engine for creating wealth, most people just don't seem to get their fair share? It's a paradox, right? American businesses create enormous value, but for so many investors, it feels like they're missing out. Well, today we're going to pull back the curtain on why that is. We're going to talk about how the winner's game of investing gets turned into a loser's game, not because of some big market crash, but because of something way more predictable, the slow, silent drain of investment costs. All right, so here's our game plan. First, we're going to unpack how a winner's game gets lost in the first place. Then we'll get into the nitty-gritty, the relentless rules of arithmetic, and the actual fees that are doing all the damage. From there, we'll see the truly shocking long-term impact of those fees. We're talking about the tyranny of compounding costs. But don't worry, it's not all doom and gloom. We'll pivot to a simple, really powerful solution. We'll even hear from some of the biggest names in finance before wrapping up with how you can make sure you get your fair share. So let's kick things off with the absolute fundamentals. When you're talking about the stock market, there are really only 2 truths you need to understand. They're super simple, but they set the stage for everything else we're going to talk about. One describes the market before costs, and the other, well, that's the reality after costs. And here it is, the simple, brutal math. Think about it. Before you account for any fees, the act of trying to beat the market is a zero-sum game. If I win, you have to lose. It's just a transfer of wealth. And if we take all of us investors together as a group, we literally are the market. So our combined return is the market's return. Makes sense, right? But the second you subtract the costs of playing, all those fees and commissions, the entire game changes. It becomes a loser's game. As a group, we now have to underperform the market by the exact amount we paid in costs. It's not a theory, it is a mathematical certainty. Okay, so how does this actually play out in the real world? To really get a handle on the problem, we've got to shine a light on the specific costs that are causing all this trouble. And these aren't just abstract ideas, these are real dollars being siphoned away from your investments, a lot of the time in ways you don't even see.
So here are the 3 main culprits. First, you've got the obvious one, the expense ratio. This is what you pay the fund manager and for all the operating costs. It averages a pretty hefty 1.5%. Next up, you've got sales charges, sometimes called loads. These can tack on another 0.5% to a full % every year. But the sneakiest one, the one that's often totally invisible, is portfolio turnover. Every single time a manager buys or sells a stock, there are trading costs, and those can easily chew up another 1% of your money year after year. And when you add it all up, the total all-in cost for a typical actively managed fund can hit 3% every single year. Now, you might hear 3% and think, so what? Well, that 3% is a massive, relentless headwind.
It's a hurdle you have to clear before you even get a chance to start earning what the market is giving away for free. This quote just nails it, doesn't it? It perfectly explains why this simple math isn't shouted from the rooftops. The financial industry has this huge, powerful incentive to keep everyone focused on, well, anything else. Picking the next hot stock, finding the genius manager. The last thing they want to talk about is the impact of their own fees. But understanding it is absolutely in your best interest.
All right, now we get to the part that is truly jaw-dropping. We're about to see how those seemingly small little annual costs, when they compound over an entire investment lifetime, turn into a number that is just staggering. This isn't just a headwind anymore. This is what we call the tyranny of compounding costs.
Let's make this real. Imagine you put $10,000 into the market. Over 50 years, with an 8% return, that could grow into almost $500,000. Pretty amazing, right? But the average fund investor, after paying all those costs, might only end up with about $145,000. That is a difference of over $323,000. So the question is, where in the world did all that money go? This chart just lays it bare. That tall blue bar, that's the magic of compounding returns. That's your money working for you. And that shorter orange bar, that's what's left after the tyranny of compounding costs has taken its enormous bite. Look how small the gap is in the early years. But over time, it becomes this massive chasm. See, costs don't just subtract from your money today, they steal the future growth on that money forever. And this is the final scorecard. It's just wild. As the investor, you put up 100% of the money. You took 100% of the risk. And for all that, you walked away with less than a third of the market's potential return. Meanwhile, the financial system, which, by the way, put up zero capital and took zero risk, gets nearly 70% of the total reward. It's not a fair share, it's the lion's share. If you remember one thing from this whole explainer, let it be this. Over the long haul, the incredible power of your returns compounding for you is completely overwhelmed by the destructive power of cost compounding against you. In the world of high-cost investing, it's a battle you are mathematically set up to lose from the very beginning. Okay, that was a lot of bad news, I know. But after staring into the abyss, let's pivot to the really good news. There is a simple, proven, and incredibly powerful solution to all of this. And the best part? It has nothing to do with finding some Wall Street genius or trying to time the market. It just relies on that same boring, common-sense arithmetic we've been talking about.
And this isn't a hypothetical. This is 25 years of actual real-world data. Between 1980 and 2005, the S&P 500 gave a return of 12.5% a year, which turned $10,000 into almost $181,000. Now, what about the average active fund manager? They only managed 10%. Growing that same 10 grand to just 98,000. But look at the low-cost index fund. It captured almost the entire market return, delivering 12.3% and turning that 10K into over $170,000. That massive difference? It's almost all because of costs.
But here's where it really hits home, because what matters isn't just the final number on your statement, it's what that money can actually buy you. This chart adjusts those returns for inflation, and now the difference is even more stark. The real profit, the actual extra spending power for the index fund investor was nearly double what the average managed fund investor got. That is a life-changing amount of money, and the difference was simply costs. Now you might be thinking this is some controversial fringe idea. It's not. It's just common sense, and you don't have to take my word for it. It's been endorsed by some of the most brilliant and famous people in the very industry that profits from high fees, the active managers themselves. First up, you've got Peter Lynch. This guy's a living legend. He's arguably one of the greatest stock pickers of all time. And after his incredible run at the Fidelity Magellan Fund, what did he say? He admitted that for most people, they'd just be better off in an index fund. When the master of the game says that, you listen. Then you've got a guy from the complete opposite end of the spectrum, Jim Cramer. He's the face of fast-paced, hyperactive stock picking on TV. And even he admits that after a whole career of trying to beat the market, the simple common sense of indexing is just too powerful to ignore. When the ultimate stock picker says he's thinking of joining the other team, you know it's a big deal. And finally, if you needed any more convincing, here's a quote from the super sophisticated world of hedge funds. Clifford Asness, a giant in quantitative investing, calls indexing the now and forever king of the hill. He knows it's not just for beginners. It's the undisputed core of what everyone should own. When the legends, the TV stars, and the hedge fund geniuses all agree, it's probably worth paying attention.
So, let's land the plane here. We've looked at the math, we've seen the long-term impact, we've checked the real-world data, and we've heard from the experts. So what does all this mean for you, for your money, and for your future? How do you make sure that you get the returns you're actually entitled to?
The bottom line is really this simple. You don't have to play the loser's game. You don't have to spend your time and energy trying to find that one needle in a giant haystack. You can just buy the whole haystack. Owning a low-cost index fund is the one strategy that pretty much guarantees you will capture your fair share of whatever growth our economy and our stock market deliver over the long run. And we'll leave you with this piece of wisdom from former Supreme Court Justice Louis Brandeis. A century ago, he was warning people about the relentless rules of humble arithmetic. And you know what? Those rules have not changed one bit. When it comes to investing, it's the simple, boring, humble math that is ultimately the mother of your financial safety and success.
And that really just leaves us with one last question. A question for you. Take a hard look at your own investments. Look at the fees, the expense ratios, all of it. And just ask yourself this simple question. Is your money set up to play a winner's game, or are you stuck playing a loser's game? The answer could literally change your financial future.
Today, we're pulling back the curtain on what might just be the biggest magic trick in the world of investing. It's a story, a mystery really, called the Grand Illusion.
So, picture this. You get your mutual fund statement in the mail. The number on it looks fantastic, right? A great annual return. You're feeling pretty smart. But what if I told you that number, the one you're celebrating, isn't actually what you earned? What if you're missing a huge part of the story?
Okay, let's dive right into this illusion. The whole idea we're exploring today is kind of shocking when you first hear it. The returns that mutual funds are so proud to report, well, they're almost never the same returns that investors like you and me actually get to keep. There's this hidden gap between the two, and trust me, it can be absolutely massive. And this slide right here, this breaks down the entire magic trick. See, on one side, funds report something called a time-weighted return. Just think of this like a perfect lab experiment. It measures how one single share performed if you bought it on day one and then never ever touched it again. But that's not how real life works, is it? We invest using what's called a dollar-weighted return. This one reflects reality. It accounts for when we get excited and buy more or get scared and sell some. One is the fund's theoretical return, the other is your actual real-world return.
And listen, this isn't just some wild theory I cooked up. The legendary founder of Vanguard, John C. Bogle, said it himself. He flat out called the idea that we investors earn the returns we see on paper a grand illusion. That's a pretty powerful warning from someone who knows the industry inside and out. It tells us we need to look past the fancy marketing and find out what's really going on.
So let's do just that. Let's start the investigation. We're about to put some hard numbers to this illusion. It's time to uncover exactly where all this money seems to just disappear.
All right, before we look at the evidence, let's just make sure we're all crystal clear on this. The dollar-weighted return, that is the only number that really matters to your wallet. It's your personal bottom line. It reflects all your real-world decisions, when you put money in, when you took it out. This right here is the truth teller. Okay, so let's set the stage. We're looking at a 25-year period, from 1980 all the way to 2005. Over that time, a dead simple stock market index fund returned 12.3% a year. That's our baseline. That's what the market itself gave us. Not bad at all, right?
Now, in that exact same period, the average actively managed equity fund, the ones with the smart managers, they reported a return of 10.0%. So right away, we see a drop from the market's 12.3%. Most of that is eaten up by the costs and fees we've talked about before. It's a pretty big hit, but it's not the whole story, not even close.
And here it is, the bombshell. The average fund investor, the actual person putting their hard-earned savings on the line, only earned 7.3%. Just look at that drop. It goes from the market's 12.3% down to the fund's 10%, and then all the way down to the investor's 7.3%. That nearly 3% gap between what the fund said it made and what the investor actually made, that is the grand illusion in action.
And if you want to see what that gap looks like in cold, hard cash, here you go. If you'd put $10,000 into a simple index fund, it would have grown to over $170,000. Not bad. The average fund would have turned that $10,000 into about $98,000. Still okay. But the average investor?
They walked away with just $48,000. That's only about 28% of what the market offered. The difference is just staggering.
So what on earth happened? Where did all that money go? This brings us to the next part of our investigation. We need to identify the culprits behind this massive gap. And as you're about to see, the culprits are, well, they're very, very human. The evidence points to two main suspects: bad timing and poor selection. To put it simply, investors consistently buy and sell at the absolute worst moments, and they pick the wrong funds to begin with. And what drives these two huge mistakes? The two most powerful emotions in investing: greed and fear.
Here's Exhibit A for bad timing. Look at this. Back in 1990, when stocks were pretty cheap, investors only put about $18 billion into funds. But then, at the very peak of the dot-com bubble in 99 and 2000, when stocks were crazy expensive, they shoveled in an average of $420 billion. And then what happened? After the crash in 2002, when stocks were on sale again, they pulled way back to just $50 billion. They bought high and sold low, the exact opposite of what you're supposed to do.
Oh, but it gets so much worse. This is where our second culprit, poor selection, enters the scene. At the absolute height of that market frenzy, a mind-boggling 95% of all new money went into the riskiest funds you could find, aggressive growth funds. People weren't just timing the market badly, they were chasing the hottest, most speculative trend with everything they had.
And the result of that chase was a total catastrophe. Just look at this table. Over a decade, those very same aggressive growth funds reported a pretty respectable return of 7.8% per year. But the average shareholder, the person actually in those funds, they actually lost money. Their return was a negative 0.5%. That gap, what they call the shareholder lag, was a devastating 8.3% every single year.
Now, it's really easy to just point the finger and blame the investor. But, they weren't acting in a vacuum. The fund industry itself played a huge role here. You could almost say they were an accomplice, aiding and abetting these emotional mistakes.
This quote just sums it up perfectly. The industry knows investors are driven by emotion, and instead of trying to calm those emotions, their marketing and promotions often pour gasoline on the fire, leading to really destructive behavior. It's a vicious cycle.
So how exactly do they do it? Well, they blast out ads showing off the amazing past returns of their hottest funds. They rush to launch new, trendy funds. Think of all the tech funds in 1999 just to cash in on the fad of the moment. And all of this marketing, every bit of it, is designed to trigger your greed and that powerful fear of missing out. Okay, so we've seen the illusion, we've uncovered the gap, and we've identified the culprits. So the big question is there a way out of this? Can we actually close this case and get the returns we deserve? The answer is yes. And you know what? It's remarkably simple. Here it is, the winning formula. Step 1. Instead of trying to pick the next hot fund, just own the entire stock market through one low-cost index fund. Boom! That completely eliminates the poor selection mistake. And step 2? Do nothing. Seriously, just stay the course, through the good times and the bad. And that eliminates the bad timing mistake. That's it. That's the whole game. And hey, don't just take my word for it. Warren Buffett famously said that an investor's two greatest enemies are expenses and emotions. The index fund solution we just talked about, it directly attacks both of those. It keeps expenses super low, and by forcing you to just stay put, it takes your emotions right out of the equation. Even Charles Schwab, a guy whose company makes a fortune selling all those actively managed funds, admits that for his own money, he's an indexer. And his reason? He says the predictability is just so high. His words were, "Why would you screw it up?" It's hard to argue with that. And finally, this is a great reminder from financial editor Mark Hulbert about the hardest part of that winning formula. It's easy to say buy and hold. Anybody can do that. But the real challenge, the thing that makes all the difference, is the hold part. Sticking with your plan when the markets are going crazy is what separates the winners from everyone else. So in the end, it all comes down to this. The system is basically designed to play on your emotions. It wants you to chase returns and run away from risk at the worst possible times. The grand illusion is powerful, but the way to beat it is simple. The only real question left is, can you conquer the greatest enemy to your own wealth, your emotions, and find the discipline to actually win? Hey, welcome to The Explainer. We talk a lot about investment fees, and we definitely feel the sting of inflation. But what if I told you there's a third, really powerful force that's been quietly devouring your investment returns? It's a huge deal, and it can turn what looks like a great investment into something, well, not so great. Let's dig in.
So here's our game plan. We're going to start by shining a light on this invisible drain. Then we'll get into why it's happening, run the numbers to see the real-world damage, and uncover a pretty surprising paradox. After that, we'll see what the experts have to say, and finally, we'll talk about how you can defend your own financial future.
All right, first up, the invisible drain. We're always told to watch out for investment costs, right? Fees, expense ratios, that kind of thing. But there's another major cost that just doesn't get the same attention. And trust me, it can be every bit as damaging to your portfolio.
So think about it for a second. You've got fees and you've got inflation eating away at your purchasing power. What's that third piece of the puzzle? What's the other big cost that's secretly shrinking your real returns, especially if you're investing in a regular, taxable account?
Yup, it's taxes. Good old federal, state, and sometimes even local income taxes. You know, for the roughly half of all investors who have their funds in taxable accounts, this is not a small thing. It is a massive factor that can completely change your financial outcome.
So why are taxes such a monster problem for so many people who own mutual funds? Well, it turns out that the very strategy most funds use today makes them incredibly, almost shockingly tax inefficient. Let's get into why that is.
Okay, this right here tells you a lot of the story. Back in the day, from 45 to 65, investing was a long-term game. The average fund only turned over about 16% of his portfolio each year. That means they held onto a stock for about 6 years. But today, that turnover rate has just exploded. It's around 100% a year. We've shifted from patient investing to what you could call frenetic, short-term speculation. And that leads to this just wild number. The average holding period for a stock in a typical actively managed fund is now just 12 months. Think about that. And every single time a manager sells a stock for a profit, that creates a capital gain, a taxable event that gets passed directly onto you, the investor. And it just chips away and chips away at your returns, year after year after year.
All right, now let's get into the real arithmetic here. It's one thing to talk about this stuff in theory, but where you really see the impact is in the cold, hard numbers. So we're going to look at a $10,000 investment over 25 years, comparing an average active fund to a simple S&P 500 index fund. Let's quantify the damage.
First, let's look at growth before taxes even enter the picture. And right away, you can see the index fund, thanks to its lower fees, is already way ahead. It turned that 10 grand into over $170,000 of growth. The average active fund? It's barely under 100,000. That is a massive head start for the index fund from the get-go.
But now, just watch what happens when we factor in taxes. That hyperactive trading in the active fund generates a huge tax bill, and its growth just plummets, all the way down to about $61,000. Meanwhile, the low turnover index fund gets to keep way more of its gains, ending up with $149,000. That performance gap just turned into a giant canyon. And let's be really clear about what that difference is. It's not just a number on a chart. It is $87,300 of real money that the active fund investor lost, gone, due to that combination of high costs and high taxes. It's a truly staggering amount of wealth that just vanished.
And believe it or not, we're still not done. We have to bring in the final villain of this story, inflation. When we adjust for the rising cost of living, we finally see the real, actual spendable profit. The index fund investor walks away with over $65,000, and the active fund investor, just $23,000. The index fund's real return is nearly 3 times bigger.
This table just lays it all out, crystal clear. You can see the story unfold at every single stage, before tax, and after inflation. That relentless 1-2 punch of high costs and taxes just devastates the active fund's returns. Meanwhile, the boring, low-cost, tax-efficient index fund just quietly protects and grows the investor's wealth.
Okay, but this is where it gets even more fascinating. There's this really weird paradox when it comes to dividends. If you just look at the surface, active funds can sometimes look more tax efficient with their dividends. But as we're about to see, it's a total illusion, and it's caused by something way worse than taxes.
Here's how the magic trick works. Let's say both an active fund and an index fund have stocks that give them a 1.8% gross dividend yield. Okay, same starting point. But then the active fund subtracts its high expense ratio. Let's say it's 1.5%. Poof, just like that, 80% of the dividend income is gone before it even gets close to you. So what's left for the investor? This tiny 0.3% net yield.
Now let's put that right next to a low-cost index fund.
It starts with that same 1.8% yield, but it only subtracts its tiny expense ratio, maybe 0.15%. The result? The investor gets a net yield of 1.65%. That is more than 5 times the dividend income. So yeah, the active fund pays less in tax on its dividends, but that's only because its own confiscatory operating costs have already taken almost all the money for themselves.
Now look, this isn't just some theory I'm spinning. There is a really strong consensus on this from some of the smartest minds in finance. So let's hear what the experts have to say about all this.
So you have researchers from Stanford and the Federal Reserve, and they found that, basically, actively managed funds have just failed. They failed to manage their portfolios in a tax-smart way. Instead, their constant trading actively drives up tax bills for their investors.
Investment advisor William Bernstein, well, he does not mince words. He says owning active funds is probably a poor idea in general, but owning them in a taxable account is a truly terrible idea. He points out that taxes can be a drag of up to 4% a year. His conclusion couldn't be clearer. For taxable investors, indexing is the way to go.
And finally, the legendary economist Burton Malkiel just hits the nail on the head. He explains that the very design of an index fund, its simple buy and hold strategy, is what makes it so tax-friendly. It just lets your money grow and compound without constantly having bits and pieces siphoned off for taxes.
So, after seeing all this evidence, what's the big takeaway here? How do we actually use this knowledge to defend our own money from these really powerful, wealth-destroying forces?
Well, it really comes down to recognizing the 3 big enemies of any long-term investor. You've got high investment costs, which eat away at your returns from the start. Then, you have the completely unnecessary annual tax bill that comes from hyperactive trading. And finally, you have the slow, steady grind of inflation that just erodes the value of whatever's left. And the single most effective shield against all 3 of these destructive forces is the simple, elegant strategy of a low-cost index fund. Its low costs mean more of your money stays invested, its low turnover slashes your tax bill, and by maximizing your net return, it gives you the absolute best chance of staying ahead of inflation over the long run.
And that really leaves us with the one question we should all be asking ourselves. It's not about the big, flashy return a fund might advertise. It's about what's left in your pocket at the end of the day, after all the costs, all the taxes, and all the inflation are paid. How much of your return do you actually get to keep? Thanks for joining us.
All right, hello and welcome. Today we're diving into a really big question, one that every single investor needs to be thinking about. What happens if the good times are over? We're going to use the incredibly simple but powerful arithmetic from investing legend John Bogle to figure out why the stock market of the future might look totally different from the past, and more importantly, what it means for you. Let's get right into it. For the last 25 years, this number has been magic, 12.5%. That was the average return of the U.S. stock market, year in and year out. It's an absolutely fantastic return that has supercharged retirement accounts and really shaped what a whole generation of us expects from investing. It felt normal, you know? It almost felt easy. And that, right there, is the million-dollar question. Was that incredible 12.5% return built on a solid foundation of real business success? Or was it getting a little extra juice from somewhere else? Figuring out the answer to that is absolutely crucial if we want to navigate the decade ahead. So, here's how we're going to break this all down. First up, we'll tackle that question. Is the era of high returns really over? Then, we'll pop the hood and look at where returns actually come from, using a simple 2-engine model. We'll take that model and look at 3 different eras to see what's changed. Then comes the really critical part. We'll see how lower returns make investment costs so much more dangerous, explore 5 paths you could take, and finally, see why this isn't just one opinion. It's what experts across the board are saying. Okay, so let's start with this idea that an era is ending. That 12.5% return feels like our baseline, but the truth is it was probably an exception, not the rule. A huge chunk of that return didn't come from companies making more money. It came from something else entirely, something that probably can't happen again. To really get why, we need to understand the machine. According to Bogle's framework, the total return you get from stocks is actually driven by just 2 simple things. The easiest way to think about it is like the market has 2 engines. One is based on reality, and the other is based on mood. And this slide just lays it out perfectly. On one side, you've got the reality engine. This is the real tangible stuff, the dividends companies pay you and the growth in their actual profits. It's the real value being created. Then, on the other side, you have the mood engine. This one is all about feelings. It's speculation. How excited or pessimistic are investors? We measure this with a price to earnings or PE ratio. When people get optimistic, they're willing to pay more for the same amount of earnings. That PE ratio goes up, and it gives returns a big boost. When they get pessimistic, it falls, and it's a drag on returns. Okay, now that we have this framework, the reality engine and the mood engine, we can use it like a lens to look at 3 totally different eras in market history. This is going to show us exactly how that balance between reality and mood has shifted, and what that tells us about what's coming next. First, let's just establish a baseline. What did the stock market look like not for just 25 years, but for over a century? This gives us the real long-term picture of how these two engines are supposed to work. And wow, check this out. It tells the story so clearly. For more than 100 years, the market gave us a 9.6% annual return. But look at where it came from. The reality engine, the investment return, delivered 9.5% of that. It was basically the whole story. It was just real business results. And the mood engine, the speculation, it added just a tiny 0.1%. Over the long haul, investor emotion was just a wash. Reality was king. Okay, now let's flip to the era that has shaped all of our recent expectations, the last 25 years. This is the period that gave us that juicy 12.5% return we started with. And here is where it gets absolutely fascinating. The reality engine, the actual business performance, was chugging along just fine. It produced a 9.8% return, almost exactly the same as the long-term average. The huge difference was the mood engine. It went into hyperdrive. Investor optimism just soared. The PE ratio of the market literally doubled, and that added an extra 2.7% to returns every single year. So think about that. Over 20% of the returns we got used to came from pure speculation, just from people becoming willing to pay more for the same dollar of earnings. So that brings us to today and to the future. If the reality engine is pretty consistent, and the mood engine just gave us a massive one-time sugar rush by doubling PE ratios, what does simple common sense tell us about the next decade? Well, this is the projection, and it's based on pretty simple math. First, let's look at the reality engine. Right now, the dividend yield is kind of low, about 2%. Let's be optimistic and say earnings grow at about 6%. Add those together, and you get an investment return of 8%. Now for the mood engine. It's highly unlikely that PE ratios are going to double again from here. In fact, it's much more likely they'll drift back down a bit. If that happens, it could subtract about 1% a year from our returns. So, you take your 8% from reality, subtract that 1% drag from mood, and you land at a projected total return of just 7%. Now, a 7% return might not sound like the end of the world, but this is where the story gets really personal. This is where the rubber meets the road, because lower gross returns make the fees you pay for your investments so much more painful. Think of it like this. In a high-return world, let's say the market's giving you 15%. If you're paying a typical 2.5% fee for an active fund, that fee eats up about 16% of your total gain. It's like a slice from a giant pizza. You notice it's gone, but there's still a ton of pizza left, so you don't sweat it too much. But now, let's take that same 2.5% fee and apply it to our projected 7% world. The math is just brutal. That fee now devours almost 40% of your entire return. Before you even think about inflation or taxes, your fund manager is taking almost half the pie. The simple arithmetic of costs just becomes relentless when returns are lower. And this chart shows you what that looks like in real money over 10 years. Let's say you invest $10,000. After you account for costs, taxes, and inflation, that investment in a low-cost index fund could grow by about $5,100. That same 10 grand in a typical high-cost active fund, it might only grow by $1,500. The index fund investor literally keeps more than 3 times the real return. The difference is just staggering. So, if this is the new reality, lower returns where costs are more damaging than ever, what are we supposed to do about it? Let's quickly look at 5 common paths an investor might choose to go down. All right, here are the options. You could try to pick a winner based on how they've done in the past, long-term or short-term. You could hire a professional advisor to help you choose. Or you could completely shift your focus. Instead of trying to find the needle in the haystack, you could concentrate on what you can actually control. Either pick funds with rock-bottom costs, or just buy the entire haystack with a simple, low-cost index fund. Now, before you start thinking this is just one pessimistic outlook, you have to know that this general forecast, that returns are going to be lower and that costs are going to matter a whole lot more, This view is widely shared among financial professionals. I mean, just look at this. Morgan Stanley went and asked the actual chief financial officers of the 100 biggest companies in the country, the people who live and breathe this stuff. Their expectation for future stock returns, 6.6%. That is right in the ballpark of the 7% projection we just walked through. Here's another heavy hitter, Gary Brinson, saying basically the same thing. He thinks anything above 7 to 7.5% is pretty much unrealistic. And then he asks the billion-dollar question. In this kind of environment, why on earth are people still willing to pay such high fees? And finally, this quote from Richard Ennis just ties it all together with a bow. He sees this dual challenge, low returns and high costs, as the very reason that investors will keep shifting their money into passive strategies like index funds. It's not a fad, it's just the logical conclusion. Which leaves us with this final, powerful thought. In an environment where every little bit of return matters and the bite of costs is so much bigger, maybe the winning move isn't to try harder, to search for that one magic fund manager. Perhaps the smartest thing you can possibly do is to stop trying to outsmart the market and instead just own the whole thing at the lowest possible cost. It's a big idea to think about. Thanks for tuning in.
You know, if you're an investor, there's this dream, right? The dream of finding that one fund, that one genius manager who just crushes the market year after year after year. It feels like the holy grail of investing. But here's the question. Is it even possible? Well, today we are going on a data-driven hunt to find out the truth.
So let's start with this famous piece of advice from John Bogle, the legendary founder of Vanguard. Now, when you first hear that, it sounds a little, defeatist, doesn't it? Like he's just telling us, hey, give up, don't even try. But hang on to that thought, because that one idea, well, it's the key to everything we're about to uncover.
But hey, we're not just going to take his word for it, are we? Let's be optimistic for a minute. Let's actually go looking for that needle. We're going to put on our detective hats, we're going to dig through decades of data, and we're going to find out the real hard numbers. What are the actual honest-to-goodness odds of picking a long-term winner from the very start?
Okay, here's our roadmap. First, we're going to talk about this search for winners. Then, we'll see what actually happens to a whole universe of funds over a long period of time. And trust me, the results are going to surprise you. After that, we'll look at what happens when winners, well, start losing. We'll dive into the cautionary tale of a Wall Street legend. And then, we're going to bring it all home and talk about that haystack.
All right, part one, the search for winners. You know, on the surface, this feels like it should be pretty easy. I mean, we're constantly hearing about these incredible funds with amazing track records making headlines. But here's the problem. We only ever hear about the ones that made it. And that creates this really deceptive picture of how easy this whole thing is. So to really get to the bottom of this, we've got to hop in our time machine. We're going to look at every single equity mutual fund that existed in the U.S. way back in 1970, and we're going to follow their story for the next 36 years, all the way up to 2005. And here it is. This is our starting line. In 1970, there were exactly 355 funds in our universe. This is our entire haystack right here. Every single potential long-term winner was in this group. So the big question is, what happened to them? And here's the first the first massive shock. Take a look at this. Out of those 355 funds, a staggering 223 of them, that's almost 2/3, didn't even survive. They just vanished. They went out of business, they emerged, they disappeared. This is what we call survivorship bias. We only ever see the funds that are still standing, not this giant graveyard of failures. Now, of the ones that did survive, 60 were straight-up losers, and 48 basically just tied the market, which leaves us with a tiny sliver, just 24 winners. I mean, just let that sink in for a second. After 36 years, only 24 of the original 355 funds actually beat the market. Your odds from the very beginning of picking one of those long-term winners were just 1 in 14. Those are pretty tough odds to bet your future on. But believe it or not, the story gets even crazier from here. So, let's zero in on that tiny group of 24 winners. These are the needles we were looking for, right? These are the champions. But did they stay champions? Let's take a much closer look at what happens when a fund actually succeeds.
This slide, man, it shows the funnel of success, and it is absolutely brutal. So we start with our 24 winners. Now, if we raise the bar just a little bit and look for funds that beat the market by more than 2% a year, that number drops to just 9. But here's the real kicker. Of those 9 genuine superstars, only 3, just 3, actually kept it up. The rest, they started to fall behind. So what's going on here? Why do these winners suddenly start to fizzle out? Well, Warren Buffett, as usual, said it best. When a fund does really, really well, people notice. Money just pours in and the fund gets massive. But that fat wallet makes it so much harder for the manager to be quick and nimble. They can't get in and out of stocks easily anymore. Success, ironically, becomes its own worst enemy.
And this chart just lays it all out. After these funds hit their peak, 6 of those 9-star managers started to lag the market, and not by a little bit. On average, by a painful 2.3% per year. They became yesterday's news. Only 3 managed to keep that magic going.
Okay, just let that number wash over you. We started with 355 funds. After 3.5 decades, only 3 of them managed to both survive and consistently deliver amazing returns. The odds of you, back in 1970, picking one of those 3 were less than 1%, 0.8% to be exact. It's almost impossible.
Now, to make all this data really hit home, I want to tell you a story about a modern-day legend. The story of portfolio manager Bill Miller is the perfect, real-world example of everything we've just seen in the numbers. It is such a powerful lesson about the dangers of chasing yesterday's winner. From 1991 all the way to 2005, Bill Miller did something that was thought to be, well, pretty much impossible. He beat the S&P 500 for 15 consecutive years. It was an unprecedented streak that made him an absolute superstar. But look closely at this timeline. The major flood of investor money didn't really start coming in until 1997, a full 7 years into the streak. Most people showed up really late to the party.
And this right here, this is the punchline. The fund's official time-weighted return looks amazing, 14.9% a year. But the actual dollar-weighted return, which shows what the average investor really earned based on when their money went in and out, was only 10.3%. So why the huge gap? Because most investors piled in after the best years were already over, right before the streak finally and dramatically came to an end. They bought the hype, not the actual long-term performance.
Okay, we've looked at the data. The odds of finding that needle are they're terrible. And even if you do find it, you're probably too late. Now, I know that might feel a little bleak, but this is where the whole story pivots to a simple, elegant, and incredibly powerful solution. And here we are, right back where we started, with John Bogle's quote. But now it makes perfect sense, doesn't it? He's not telling us to give up. He's telling us to change the rules of the game. Stop the impossible search for that one tiny winner, and instead, own all of them. The winners, the losers, the average ones, the whole market.
So what exactly is the haystack? It's a total stock market index fund, and it's a beautifully simple concept. Instead of paying some manager a ton of money to try and pick winning stocks, an index fund just buys a tiny piece of every stock in the market. Its goal isn't to beat the market, its goal is to be the market, to deliver you the market's return, minus a teeny tiny fee.
And look, this isn't some crazy, out there idea. We're talking Nobel Prize-winning economists like Paul Samuelson, who told investors to forsake the search for such tiny needles in huge haystacks. Respected writers like Jonathan Clemens compare picking winning funds to trying to predict the dice. By just buying the haystack, you guarantee you'll get the return of the entire market's growth, a strategy that, as we've just proven, beats the vast majority of experts over the long haul. You know that warning you see on every single mutual fund ad? Usually in tiny print at the bottom? It's a legal disclaimer they have to include. But after everything we have looked at today, the shrinking funds, the fading winners, the story of Bill Miller, that phrase, it takes on a whole new meaning. This time, you should actually believe them.
So I'll just leave you with this one final question. The data is clear, the logic is powerful, and the alternative is so simple. Why would you spend your time and your energy searching for a tiny needle that you have a 0.8% chance of finding when you can guarantee yourself the market's return by simply buying the entire haystack? Thanks for joining me for this explainer.
You know, we're always told that past performance is the best way to predict future success. But when it comes to investing, is that really true? Or could it be that chasing yesterday's winners is actually the fastest way to become tomorrow's loser? That's exactly what we're going to dig into.
So here's our game plan. First, we're going to tackle something called the 5-star trap. Then we'll dive into a wild story of boom and bust straight out of the dot-com era. After that, we'll uncover the hidden losses that so many investors never even see, and we'll explain the powerful law of reversion. And finally, we'll hear from some experts about how we might all just be getting fooled by simple random chance.
All right, let's kick things off with a really common shortcut. I mean, when you're staring at thousands of different investment choices, how do you even begin to pick the best one? Well, for a lot of the people, the answer seems obvious. Just look for the highest rating. But here's the thing. That shortcut can lead you straight into a trap.
Look, it's a problem we all face as investors, right? You've got your hard-earned savings, you want to see them grow, but the number of options out there is just, it's completely overwhelming. So where do you start? How do you find a fund that's actually going to do well?
For millions of people, the answer is to follow the stars. And I'm talking about Morningstar's famous rating system. And get this, the data is just stunning. 95% of all individual investment money flows into funds that have 4 or 5 stars. The logic feels solid, right? Pick the top-rated funds and you'll get the best results. But what if that whole logic is just wrong?
Well, here's the catch. The star ratings have this hidden, critical flaw. They are massively biased towards what's happened very, very recently. Just look at these numbers. For a newer fund, a staggering 2/3 of its entire rating comes from just the last 2 years of performance. So what does that really mean? It means the system isn't rewarding long-term steady quality. It's rewarding short-term, flashy hot streaks. And that, my friends, changes everything.
Okay, so does this whole strategy of chasing the hot 5-star funds actually work out? Well, analyst Mark Holbert put it to the test over a 10-year period. He built a portfolio that only held 5-star funds, and he was constantly updating it to make sure he always had the winners. And the result? An annual return of just 6.9%. Now, during that same time, a simple, boring, unmanaged total stock market index fund returned 11%. That is a massive underperformance. And here's the kicker. That 5-star portfolio was actually taking on more risk than the overall market. Ouch.
And this isn't just some abstract theory. To really see what happens when an entire market gets swept up in chasing hot performance, we have to go back in time. Let's revisit one of the most dramatic periods in modern financial history, the dot-com bubble of the late 90s. This is where the danger becomes, well, really painful.
So from 1997 to 1999, the market was an absolute inferno, completely driven by internet, tech, and telecom stocks. And these funds right here, these were the rock stars, the heroes of the era, the top 10 best-performing funds. I mean, these guys were legends. The returns were just astronomical, averaging an incredible 55% per year. Over those 3 years, that's a cumulative return of nearly 280%. Everyone thought they'd found the golden ticket, the secret to getting rich forever.
But you know what they say, the first shall be last, and the market was about to serve up one of the most brutal lessons imaginable.
And wow, did things reverse. Over the next 3 years, from 2000 to 2002, the bubble burst and the crash came. Just look at what happened to our heroes. Every single one of those top 10 funds plummeted to the absolute bottom of the rankings. The fund that was number 1, RIDEX OTC, crashed down to rank 841 out of 851. And Van Wagner, which was number 9 on the way up, ended up dead last on the way down. On average, these former superstars were outperformed by 95% of their peers. Their average return was a catastrophic negative 34% per year.
So that's the story of the funds themselves. But believe it or not, the story for the actual people who invested in them is even worse. And this brings us to a crucial, often totally hidden trap: the huge gap between a fund's official, on-paper return and the return that investors actually end up with in their pockets.
It really all comes down to 2 very different numbers. On the left, you have the fund's official return, what it earned on paper over the full period. But on the right, you have your return, which is all about when you bought and when you sold. And as we're about to see, investor timing makes all the difference in the world. Now, if you look at the entire 6-year roller coaster, the 3 years of insane boom followed by the 3 years of brutal bust, the average fund on our list still managed to eke out a positive return of 13%. So on paper, it wasn't a total wipeout. But remember, that's just the paper return.
This is the reality for the average person who invested in those funds, a staggering, gut-wrenching loss of 57%. So why the massive difference? It's all about timing. Almost nobody was actually in these funds during the big run-up. They saw the amazing returns in the news, got excited, and then they piled in right at the top, just in time to ride it all the way down. They bought high and sold low, and more than half of their money just vanished.
Now, this isn't just some crazy one-off story about a market bubble. It's a perfect illustration of a powerful, almost gravitational force in finance. It's known as reversion to the mean.
Simply put, reversion to the mean is just the idea that extreme results, both really good and really bad, they just don't last forever. Things eventually drift back towards the average. A fund manager who has one absolutely incredible year is statistically far more likely to have a perfectly average or even a below average year next than they are to repeat that incredible performance. What goes way up tends to come back down to earth.
And I love this analogy for it. We think we're investing in a fixed star, a permanent, brilliant source of light and returns. But all too often, what we're actually chasing is a comet. Something that lights up the sky for one spectacular, breathtaking moment before it flames out and disappears forever.
And look, this isn't just some vague idea. The data on this is crystal clear. In 2 separate decade-long studies during much more normal markets, researchers tracked the top 20 best-performing funds each year. And what happened the very next year? Well, those champions didn't stay champions. They fell right back into the middle of the pack, performing just a tiny bit above average. It proves time and again that reversion to the mean is the rule, not the exception.
Now, if you're still not totally convinced, let's hear from some of the smartest people in the business. Some of the sharpest minds in finance have looked at this very question. And their conclusions are, shall we say, pretty direct.
The author Nassim Nicholas Taleb has this brilliant thought experiment. Imagine you have 10,000 fund managers who do nothing but flip a coin each year to make their picks. After 1 year, half of them, 5,000, will have a winning record. After 5 years, about 300 of them will have 5 winning years in a row just by pure chance. They'll be on the cover of magazines, hailed as geniuses. But they're not. They're just lucky. His point is that in a market big enough, a few great track records are guaranteed to be created by nothing more than dumb luck.
So how long would it actually take to prove that a manager's success is due to skill and not just luck? Well, according to money manager Ted Aronson, longer than any of us are going to be around. He calculates that to be statistically certain, you might need, wait for it, nearly 1,000 years of data. So what does Aronson, a guy who picks stocks for a living, do with his own money? He puts it all in Vanguard index funds, saying, indexing wins, hands down.
And finally, the respected financial columnist Jason Zweig just puts it as bluntly as you possibly can. His conclusion after looking at all the data, that this very common practice of chasing past performance is, quote, one of the stupidest things an investor can do.
So all of this brings us to the final question, the one I really want you to take away from this. When you look at your own investments, at the funds you've chosen, what are you really betting on? Are you confident you've found durable, repeatable skill? Or is it just possible you've been drawn to the beautiful, fleeting light of a comet, banking everything on last year's luck? It's definitely something worth thinking about.
Hey there, when you first start investing, you hit this big fork in the road, right? Do you try to figure it all out yourself, or do you pay an expert to pick the winners for you? I mean, getting help seems like the obvious choice, but is it really? Today, we're going to dig into that.
I mean, that's the big question, isn't it? You pay a pro because you think, hey, this person knows what they're doing, they'll give me an edge. But what if that's just not true? We're going to follow the cold, hard data and see if that advice you're paying for is actually making you money or costing you a fortune. All right, so here's the game plan. First, we'll talk about why this is such a tough spot for investors. Then we'll jump right into the data. We've got a wild story to tell. And then we'll see what happens when the experts go head-to-head with a super simple strategy. Finally, we'll figure out what a good advisor is actually for. Okay, let's just admit it. Trying to pick winning mutual funds it's just completely overwhelming. The market is this giant, massive haystack. And finding that one golden needle feels impossible. And of course, there's always someone trying to sell you a map. So it's really no wonder that most of us just throw up our hands and decide to hire a guide. And yeah, the numbers totally back this up. Get this, a whopping 70% of American families who own mutual funds, they don't do it themselves. We're talking about a massive majority here, something like 40 million families handing over their financial future to a professional. So this all hinges on one big assumption, right? The idea that these advisors, well, that they're just better at picking funds than you or me. And it seems logical, but when some researchers over at Harvard Business School decided to actually test that idea, wow, what they discovered was, frankly, kind of shocking. So here's what they did.
They looked at data over 7 years and split everything into 2 simple buckets. In one bucket, you've got funds sold by brokers, the ones advisors recommend. And in the other bucket, you've got the funds that people researched and bought all on their own. And here's the punchline. Just look at this. It's not even close. The funds sold by advisors, they returned a pretty pathetic 2.9% a year. But the funds that regular folks picked for themselves, 6.6%. That's more than double the return. So why the huge gap? Well, the study found that advisors were often pushing funds that were part of some hot new trend, and surprise, surprise, also had higher fees. Both of those things just chewed away at their clients' money.
And if you want to see what that performance gap costs in real dollars, well, here it is. We're not talking about a small difference. The researchers figured out that this bad advice cost investors, are you ready for this? A staggering $9 billion. Not in total, every single year. It's just mind-boggling.
So, you've got to be asking, how in the world does this happen? How does it get this bad? To really understand it, let's go back in time. We're going to zoom in on a perfect cautionary tale from the height of the dot-com bubble, and it stars one of the biggest names out there, Merrill Lynch. Okay, just follow this train wreck. It's March 2000. The dot-com craze is at its absolute peak. Merrill Lynch decides to launch 2 shiny new economy funds. Their brokers get on the phones, they push hard, and they pull in a massive $2 billion from clients. The timing, it was literally the worst it could have possibly been. One fund, the Internet Strategies Fund, just completely imploded. It lost 61% by the end of the year and was eventually just put out of its misery after losing 86% of its value. The other fund was like watching a car crash in slow motion, eventually losing almost 80 cents on every dollar invested. And this right here, this is the core of the problem. For Merrill Lynch, this was a huge success. I mean, from a marketing perspective, they knocked it out of the park. They sold a story, they made a ton of money in fees, but for the people who actually invested, it was an absolute catastrophe. And that just lays bare the huge conflict of interest, doesn't it? The thing that's easiest for a big firm to sell is very often the absolute worst thing for you to buy. Now, it's easy to think, okay, that was just one crazy story from the dot-com bust. But it's not. This pattern shows up again and again. So let's pull back and look at a couple of long-running contests that put the experts to the test. It was the pros versus the simplest investment you can possibly imagine, a plain vanilla index fund. All right, first up, the New York Times contest back in '93. They picked 5 top-tier financial advisors, gave each of them a fake $50,000 and said, go for it. See what you can do over 7 years. Their only opponent? A boring S&P 500 index fund. And you can see the results right here. The advisors, they did okay, They turned their 50 grand into an average profit of around 88,000 bucks. But the simple do-nothing index fund, it absolutely demolished them, bringing in over $138,000. And here's the real kicker. Not a single one of the pros even managed to beat the index. Okay, so 7 years isn't long enough. Let's go bigger. Mark Holbert tracked a bunch of those expert investment newsletters for 26 years, and the results were just brutal for the so-called experts. For starters, most of them didn't even survive. They just went out of business. Of the tiny handful that were still around at the end, only 3, just 3, actually beat the market. But look at what that means for your actual money. 100 grand in a simple index fund would have grown to almost $2.5 million. But if you'd followed the average advisor's advice, you'd have about 1.4 million. We're talking about $1 million gap. It's staggering. So after watching this play out for decades, Holbert's conclusion is just so direct and so powerful. He basically says you can beat 80% of other investors just by buying an index fund and then doing nothing else. The data is just overwhelming. The best path isn't finding some guru, it's just buying the whole market and walking away. Okay, so after all this, you might be thinking, so are all financial advisors just a total waste of money? And the answer is no, not at all. It's just that their value isn't where most people think it is. The evidence is crystal clear. As a group, they are just not good at picking winning funds. A good advisor's real value, it's found in something completely different. Look, the real worth isn't in trying to be a stock market wizard. It's in being a financial planner. A great advisor helps you see the whole board. They help you build a solid asset allocation strategy. They help you with taxes. They help you plan for the long haul for retirement. And honestly, maybe the most important thing they do is act as your coach. They're the person who talks you off the ledge when the market is crashing and you want to sell everything. And that right there can save you from making the biggest mistakes of your investing life. So if you decide you do want that kind of help, how do you find someone who's actually on your side? Well, the great financial writer William Bernstein has this brilliant, simple 3-question test. Number 1, are they fee only? Meaning, do you pay them directly or are they getting kickbacks and commissions for selling you stuff? Number 2, are their fees reasonable? You're looking for something under 1% a year, ideally. And number 3, do they use low-cost index funds or are they still trying to sell you on the fantasy that they can pick winners and beat the market?
All right, let's bring it all home. We've looked at the Harvard research, we've seen that Merrill Lynch disaster, we've watched the experts get beaten in contests, and when you filter out all the noise from the financial industry, one message just rings out loud and clear.
And here it is, the absolute bottom line. The number one reason people think they're hiring an advisor to pick winning investments for them is the one thing that all the evidence shows they consistently fail to do. It's just a loser's game, and when you play it, the odds are just massively stacked against you. And this isn't some abstract academic debate. This right here shows you what it costs you over an entire lifetime. Choosing to follow the average advisor instead of just buying a simple index fund could literally cost you more than $1 million by the time you retire. I mean, that's not just a little bit of money. That's a completely different life.
So that brings us right back to where we started, that giant haystack. All the data shows that the fund managers who can actually beat the market are incredibly, incredibly rare needles. And hiring someone to help you look, well, it doesn't just not help, it actually seems to make your odds worse. So the real question you have to ask yourself is this. Knowing how unlikely it is to ever find that needle, does it make any sense at all to pay someone for the search?
You know, every single investor, whether you're just starting out or you've been at it for years, you face the exact same question. How do you pick a mutual fund that's actually going to beat the market? We're always told to look at past performance, but let's be honest, that's a pretty shaky foundation to build your future on. So what really makes the difference for long-term success?
This slide right here really gets to the heart of it. Past performance? It's like the weather. It's completely unpredictable. It comes and it goes. A fund that's a rock star one year can be a total dud the next. But fund costs? Oh, those are like gravity. They are always there, relentlessly pulling down on your returns day in and day out. And that's the real battle every investor needs to understand.
So we're stuck in this classic dilemma. Our instincts tell us to pick the funds that have a great track record, right? Whether it's over the last year or the last 10 years. But the hard truth, and we've seen this proven over and over again, is that strategy just plain doesn't work. Chasing yesterday's winners is probably one of the most common and most expensive mistakes you can make as an investor.
Okay, so that brings up a really important question. If performance is so unreliable, is there anything we can actually count on? Is there one single factor that's been there all along, one that can help us predict what's coming? Well, the answer is a big, flashing yes, and it's probably not what you're thinking.
And that answer is costs. Yep, I know, it's not sexy, it's not flashy, but it is hands down the single most reliable predictor of how a fund will perform in the future. And why is that? It's because unlike performance, costs are incredibly persistent. High-cost funds pretty much always stay high-cost, and low-cost funds tend to stay low-cost. They are the one anchor of certainty you can cling to in a crazy, volatile market.
Now, when we say costs, it's not just one single number. You really have to think about 3 big pieces. First up, you've got your expense ratios. That's the yearly fee a fund dings you with. Second, sales charges, sometimes called loads, which you might pay when you buy or sell. And third, the one that's often hidden in the shadows, portfolio turnover costs. These are the costs the fund racks up every time the manager trades a stock. And guess what? All 3 of these costs tend to be very sticky over time.
Let's drill down on that last one for a second, because it's the cost most people completely miss. Portfolio turnover is just a measure of how often a manager is buying and selling stocks inside the fund. Well, every single one of those trades has a cost, commissions, spreads, and those costs get passed right on to you, the investor. A really simple rule of thumb from the book is to just assume your turnover costs are about 1% of whatever the turnover rate is. So you see a fund with 100% turnover, you can bet that's at least an extra 1% in hidden costs you're paying every single year.
So it all boils down to this incredibly simple, inescapable piece of math. Every single dollar you pay in fees, in charges, in hidden trading costs, that's a dollar that is not going into your pocket. It's a direct transfer of wealth from your account straight to the fund management company. It doesn't get any clearer. The more they take, the less you make.
Okay, enough with the theory. Let's look at the cold, hard evidence.
We're about to dive into a whole decade's worth of data that really shows the devastating impact that costs have on your returns. And believe me, this is where the argument becomes completely undeniable.
So this slide just lays it all out there. The data took all the stock funds and split them into 4 groups, or quartiles, based on their total costs. Now, let's just look at the 2 extremes. The lowest cost group paid on average just 0.9% a year. The highest cost group, a whopping 3.0%. And the result of that huge cost difference? Well, the low-cost funds delivered an 11.7% annual return, while the high-cost funds gave their investors only 9.0%.
Let's just visualize that for a second. That gap between 11.7% and 9.0% is 2.7 percentage points. Now, that might not sound like a ton, but remember, this is an annual difference. Over your investing lifetime, a gap like that is absolutely staggering. And notice this. The cost difference between the 2 groups was about 2.1 percentage points, which accounts for almost the entire performance gap. And that's the whole ballgame right there. Before you even factor in fees, the gross returns of all these funds were nearly identical. It was the costs, and pretty much only the costs, that created this massive difference in what investors actually got to keep. This isn't about finding a genius manager, it's all about avoiding the drag of high fees.
But wait, it actually gets even crazier. You might be thinking, well, okay, maybe those high-cost funds were taking on more risk to try and get higher returns, and it just didn't pan out. The data shows the complete opposite was true. The highest-cost funds not only gave you lower returns, they did it while taking on 34% more risk than the lowest-cost funds. So let me get this straight. You are paying more for worse returns and a much bumpier ride. What a deal.
So now let's see what this looks like when it compounds over time. What does an 11.7% annual return actually mean for your money? Well, over that 10-year period in the study, the lowest cost funds delivered a total gain of 207%. Your initial investment more than tripled. Now let's compare that to the high-cost funds. Their 9% annual return, that resulted in a total gain of just 118%. Your investment barely even doubled. I mean, that is a gigantic difference in your final outcome. We're talking about nearly double the profit, and it's driven almost entirely by that initial difference in cost. And that's really all this is. It's not some super complex financial theory that only a Wall Street quant can understand. It is, as the book puts it so perfectly, simply the relentless rules of humble arithmetic. Tiny little differences in cost, when compounded over years and decades, lead to profoundly different financial futures. It is a mathematical certainty.
This all leads us to a pretty logical conclusion, doesn't it? If our number one goal is to minimize costs so we can maximize our share of the market's return, where do we go? If fishing in the low-cost pond is the winning strategy, what does the absolute lowest cost pond actually look like?
The answer, my friends, is the index fund. Instead of paying some manager a huge fee to try and, let's be real, usually fail, to find that one winning needle in the giant market haystack, you can just buy the entire haystack for a tiny fraction of the cost. An index fund simply owns all the stocks in a market index, like the S&P 500, and it just passes along whatever returns the market gives, minus a teeny tiny fee.
Let's put the index fund in a head-to-head matchup with the average actively managed fund. I mean, look at this cost difference. It's just incredible. 1.9% for the average fund versus a minuscule 0.2% for the index fund. And the result, after you adjust for risk, the index fund delivered a 194% gain, completely crushing the average fund's 154%. It's what you might call the investor's trifecta: less cost, less risk, and more return.
And that's the whole strategy in a nutshell. If you just accept the fact that costs are the biggest thing determining your long-term returns, then your only goal should be to find the lowest cost investment you can. And that vehicle, without a doubt, is the index fund. It is the absolute lowest cost pond you can possibly fish in.
Now, look, you don't have to just take my word for it, or even just the books. The evidence for this has become so overwhelming that even some of the biggest skeptics in the financial media had to finally throw in the towel and admit it. Let's see what the executive editor of Money Magazine eventually had to say.
This quote just perfectly captures the beautiful paradox of index investing by just aiming to get the market's average return. And here's the key: keeping almost all of it for yourself by keeping costs low, you give yourself the absolute best possible chance of finishing way ahead of most other investors who are busy paying high fees to chase performance. It turns out, gunning for average is actually the superior strategy. And so, that leaves us with one last really critical question for you to think about. We've gone through the data, we get the math. So now it's time to take a hard look at your own portfolio.
Do you actually know what you're paying in total costs? Because after seeing all this evidence, the most important question you should be asking is, are you sure those costs aren't silently eating away at your future?
You know, in the world of investing, we're constantly sold this story that you need complexity to win. We get flooded with expert predictions, endless choices, and strategies so intricate they're supposed to be some kind of secret. But what if all of that is just noise? What if the real path to winning isn't about finding the most complicated strategy, but embracing the most beautifully simple one? Today, we're going to dive into a really powerful idea, that true, lasting success in investing comes from simplicity, and it's backed not by someone's opinion, but by the undeniable, relentless power of simple math.
All right, so here's our game plan. We're going to kick things off with what's called the winner's losing game. Then we'll meet the hero of our story, the low-cost index fund. After that, we'll get into the hard math that proves why it's so powerful, and then, and this is important, we'll see why not all index funds are the same. Then we have to confront the biggest hurdle of all, our own human nature. And finally, we'll wrap it all up and see why trusting simplicity is the smartest move you can make.
So what exactly is this winner's losing game? Well, it's the hunt that basically every active investor goes on, trying to pick that one genius fund manager who's going to consistently beat the market, year after year. It sounds totally doable, right? But in reality, it's like searching for a single magic needle in a gigantic, ever-expanding haystack. As we're about to find out, it's a game that for almost everyone who plays is mathematically destined to fail before you even start.
And the reason we can say that so confidently really boils down to this one crucial point. This whole argument isn't built on a gut feeling or some hot tip from a market guru. Nope. It's built on a foundation of cold, hard, undeniable math. These are the relentless rules of humble arithmetic. And as we're going to see, ignoring them is probably one of the most expensive mistakes an investor can ever make.
Okay, so if trying to find that one magic needle in the haystack is a fool's errand, what's the alternative? Well, it's actually incredibly simple. You just buy the whole haystack. And this is where we meet the hero of our story, the all-market low-cost index fund. Its superpower doesn't come from brilliant stock picks or fancy algorithms. It comes from its pure, beautiful simplicity.
So let's be super clear on what an all-market index fund actually is. It's a type of fund that completely gives up on the game of trying to pick winners. Instead, its one and only job is to own a tiny piece of every single stock in the market. By doing that, you're guaranteed to capture the market's overall return. And the two magic ingredients that make this whole thing work are its huge diversification and, most importantly, its rock-bottom operating costs.
And just how low are we talking? Well, check out this number, 0.10%. That's the annual fee for some of the best index funds out there. To put that in perspective, that is 80% cheaper than even the lowest cost quarter of actively managed funds. This tiny, almost invisible fee, that is the secret weapon that gives the index fund a massive, almost unbeatable advantage over the long haul.
Now for the proof. Because, talk is one thing, but the numbers, they tell the real story. So let's look at the hard evidence that backs this whole strategy up. We're about to dive into some powerful statistical models that show with stunning clarity why professional managers trying to beat the market are basically fighting a losing battle against simple arithmetic.
The tool that gives us this amazing foresight is called a Monte Carlo simulation. I know, it sounds super complex, but the idea is actually pretty intuitive. Imagine you could live through thousands of different 50-year investment lifetimes, just to see what would happen. A computer basically does that for us. It takes decades of real market returns, shuffles them up into countless random sequences to create thousands of possible futures, and then it checks how an active manager would have done against a simple index fund in each of those timelines. It's not a crystal ball, but it's the closest thing we have to a statistical weather forecast for your portfolio. And this chart, wow, this chart reveals the absolutely devastating story that the simulation tells. In any single year, an active manager has about a 1 in 3 shot, 29%, of beating the index. So not great odds, but it can happen. But just look at how that advantage completely crumbles over time. After 25 years, the chance of that same manager still being ahead plunges to just 5%. And over a full 50-year investing career, it's a tiny, tiny 2%. The longer you play the game, the more the relentless drag of higher costs and fees just grinds active strategies into dust.
Let's just pause on that final number for a second. 2%. After a lifetime of saving and investing, these powerful models predict that only 2 out of every 100 active funds will have managed to beat a simple, boring, low-cost index fund. The odds are just overwhelmingly, brutally stacked against you. The math, like we said, is relentless. Okay, so you're on board. Indexing is the way to go. You figure, great, I'll just pick any fund that tracks the S&P 500 and I'm all set, right? Well, not so fast. This is a really critical secret. While 2 index funds might hold the exact same stocks, their costs can be shockingly different, and those seemingly tiny differences in fees can blow a massive hole in your final returns.
This table just lays it all out in black and white. Up top, you've got a low-cost fund, like one from Vanguard. Its total annual cost is a tiny 0.09%. Simple, clean. But now look at the bottom line. A fund from a big bank like Wells Fargo. Its stated expense ratio is already way higher, but once you tack on sales charges and other hidden fees, the real annual cost to you balloons to 1.39%. That is over 15 times more expensive for the exact same product. It's crazy.
So, what's the real-world damage of that difference? Let's say you invested $10,000 back in 1984. In that low-cost Vanguard fund, your profit would be over $122,000. Not too shabby. But in the high-cost Wells Fargo fund, holding the identical stocks, your profit is just over $99,000. That's a staggering $23,000 difference, money that just vanished from your account and went straight into the fund company's pocket, not yours.
And if you want to understand the mindset behind those outrageous fees, this quote really says it all. When a Wells Fargo representative was asked years ago to justify their high charges on a simple index fund, this was the blunt response they gave. It wasn't about delivering value to the customer, it was about protecting a cash cow for the company. It's a stark reminder to always read the fine print. Make sure the fund is your cash cow, not theirs. So you've done everything right. You've embraced simplicity. You've picked the absolute lowest cost index fund on the planet. You are set for life, right? Well, unfortunately, there's one final boss in this game, and it is the most dangerous one of all. It's your own emotions. Our perfectly normal human behavior can completely sabotage an otherwise perfect strategy.
To see this destructive force in action, we're going to look at a powerful cautionary tale. It involves 2 different Vanguard index funds, one focused on growth stocks and the other on value stocks. The huge gap between the return the funds officially reported and the return the average investor actually got, well, it's a masterclass in the dangers of chasing whatever's hot.
First, let's look at the official number. Since 1993, the Growth Index Fund reported an excellent annual return of 9.1%. So if you had just bought it and held on for the whole ride, this is the return you would have gotten. A really solid performance by any measure. But now, look at this. This is the actual return that the average investor in that very same fund received, 0.9% a year. It's just a tragically pathetic result. So how on earth is that even possible? Well, this number reflects when people actually put money in and took it out. And what it shows is that people poured money in after the fund's best years, right at the top of the dot-com boom, and then panicked and pulled it all out when it crashed. They bought high and sold low. The absolute classic investor mistake. And that brings us to this one essential truth. Chasing after-the-fact popularity, basically piling into an investment just because it has recently done really well, is a guaranteed recipe for disaster. Our emotions push us to do the exact wrong thing at the exact wrong time. The lesson here is that it's not enough to pick the right strategy. You have to find the discipline to actually stick with it, especially when it feels uncomfortable.
Okay, so let's bring all this together. The evidence we've seen is clear, it's powerful, and it's pretty overwhelming. The most effective investment strategy also happens to be the most simple. And to really put a final point on this, let's hear from one of the greatest investment minds of all time on why complexity is the enemy and why true simplicity is the ultimate form of sophistication.
This is just a brilliant, cutting analogy from the late, great Charlie Munger, Warren Buffett's longtime partner. He compares the whole world of active finance, the managers, the brokers, the consultants, to casino croupiers. All of their combined fees, commissions, and trading costs are the croupier's costs, which is basically the house's take that all investors as a group have to pay. And his conclusion is both logical and just devastatingly simple. The wisest choice is to fire the croupiers altogether and just buy the whole market with an index fund.
And that leaves us with this one final, really important question to ask yourself. Take an honest look at your own investment portfolio. Are all the layers of complexity and the fees you're paying, are they truly designed to help you build long-term wealth? Or is your strategy, when you really get down to it, mostly designed to make someone else rich by paying the croupier? The answer, as that humble arithmetic shows us, is probably a lot simpler than you think. You know, when we talk about low-cost investing, our minds usually jump straight to stocks, right? But what if I told you that the simple, powerful rule of keeping your costs down is actually even more of a game changer for the so-called safer part of your portfolio? Well, today, we're diving deep into the relentless, unavoidable arithmetic of bond and money market funds. So, let me ask you a question right up front. That person managing your bond fund, are they some kind of financial genius? Can they really outsmart the entire fixed income market? Well, here's the punchline, and it's a big one. When it comes to bonds, it just doesn't really matter. See, unlike the stock market with its thousands of variables, the bond market is overwhelmingly dominated by one single, powerful force. And that force is the prevailing level of interest rates. This is like a massive ocean current that no fund manager, no matter how brilliant they are, can control or influence. They can't just pick up the phone and ask the Federal Reserve to change things for them. And what that means is, over the long haul, their gross returns, that's before fees, are almost always going to just mirror the market.
So what levers can a manager actually pull to try and get an edge? Well, they can take on more risk. They can buy longer-term bonds, which get bounced around more by interest rate changes, or they can dip into lower quality bonds, junk bonds. But here's what they can't do. They can't overcome what we call the cost handicap. Those fees and expenses they charge create this constant drag on performance that is just about impossible to beat year after year.
All right, so how are we going to prove this? Well, we're going to build the case together piece by piece. We'll start by looking at the hard data from taxable bonds, then move on to municipal bonds, and even the super safe world of treasury bonds. And then we'll put this whole theory to the ultimate test with money markets before we wrap it all up into a simple, winning strategy that you can use.
Okay, let's get to our first piece of evidence. We're going to start in the most common playground for bond investors, intermediate-term taxable bond funds. These are the funds that hold a mix of corporate and government debt.
Now, just look at the numbers on this table. This covers a 10-year stretch from 1996 to 2006. The Vanguard Index Fund, with its tiny 0.18% expense ratio, came in at 6.79% a year. Now look at the average actively managed fund, just 5.5%. And why? Well, a huge part of that is its much higher 1.00% expense ratio.
And this is where that seemingly small percentage difference just explodes. Over those 10 years, if you put $10,000 in the average active fund, it grew to about $17,000. Not bad. But in the low-cost index fund, that same $10,000 grew to over $19,200. That's a staggering difference. More than $2,200 of your money just gone, eaten up by higher fees.
So this just perfectly illustrates the trade-off, right? You might think, well, I'm paying that 1% fee for better risk management. And okay, it's true. The active funds were a little less bumpy, but the cost handicap was so huge that even with less risk, they delivered a way lower net return. The simple index strategy was a clear winner, beating an incredible 550 of its 570 competitors.
Okay, so does this idea hold up everywhere else? Let's check out the world of tax-exempt municipal bonds, a big favorite for people in higher tax brackets. As you're about to see, it's pretty much the exact same story.
Now, in this category, there aren't a ton of pure index funds, but we can use Vanguard's low-cost, super diversified fund as a pretty close stand-in. And again, same old story. It delivered a 5.85% annual return with a tiny 0.15% expense ratio. Meanwhile, the average active fund, just 5.01%, with a hefty 1.03% fee. And looking at the final results, that same $10,000 investment grew to over $17,600 in the low-cost fund. For the average fund, just over $16,300. That's another $1,300 left on the table. And what's absolutely fascinating here is that the active managers were actually taking more risk by holding more lower-rated bonds, and they still couldn't beat the drag of their own high costs. Okay, for our third case study, let's strip out pretty much all the risk. Let's look at funds that invest in the safest debt on the entire planet, short-term U.S. Treasury bonds.
Surely, the active managers have an edge here, right?
And the answer is a huge, resounding no. I mean, in a market where everybody is holding virtually identical, ultra-safe stuff, the Vanguard index fund and the market itself returned an identical 5.06% per year. The average active fund? Only 4.54%. And the culprit is that massive 0.92% average expense ratio. It's totally a self-inflicted wound.
This chart just confirms the pattern. It's undeniable at this point. The lowest cost option wins again, turning $10,000 into almost $16,400, while the average fund barely made it past $15,500. This dead simple low-cost strategy beat out 97 of the 122 funds in this category. The math is just relentless.
Before we jump into our final case study, let's just pause for a second on this thought from former Supreme Court Justice Louis Brandeis. Arithmetic is the first of the sciences and the mother of safety. It just perfectly captures the simple, powerful truth that we're talking about today.
All right, it's time for the ultimate test. We're going to look at money market funds. This is a place where the products are so similar, they're basically commodities, and where simple arithmetic is the absolute king. So money market funds are designed to be stable, to be safe. They hold really short-term, high-quality debt, and their share price is supposed to stay locked at $1. And because their holdings are so similar from one fund to the next, their performance really just comes down to one single thing: cost.
Now, I want you to pay really close attention to the gross return column on this slide. Look at those numbers: 4.07%, 4.07%, 4.05%. They're almost identical. Before fees, all of these funds are earning pretty much the exact same return. But look what happens after fees. The picture changes completely. The low-cost Vanguard fund gave 3.77% back to investors, while the average fund delivered only 3.25%. That entire difference was created almost exclusively by that huge gap in costs.
And it gets even worse. If you can believe it, the data shows that the most expensive quarter of all money market funds had a shocking average expense ratio of 1.39%. They took a perfectly good 4.1% gross return and only handed back 2.7% to their investors. I mean, why would anyone on earth pay that much for a commodity product? It is a very, very hard question to answer.
So, after looking at all this evidence across 4 different markets, the verdict is in and the conclusion is, well, crystal clear. And it leads us directly to a simple, common-sense winning strategy.
The big takeaway from all this is refreshingly simple. You do not need a genius fund manager. You just need to follow 4 basic common-sense rules. First, diversify broadly. Second, and this is the most important one, minimize your costs at all costs. Third, eliminate sales loads. That means never ever pay a commission. And fourth, invest for the long term. If you follow this strategy, it is the surest way to earn your fair share of whatever the bond and money markets are going to give you.
And that really leaves us with just one final thought. After seeing how powerfully costs crush your returns in fixed income, after seeing the relentless arithmetic at play, the only question left to ask yourself is this: why would you ever choose to pay more only to get less?
You've probably heard the advice a million times. Just buy a low-cost index fund, own the whole market, and call it a day, right? It's simple, it's been proven to work, but what if it's not the smartest way anymore? Well, a whole new breed of fund has popped up, and they're making a really bold claim. They say they've built a better index, one that's designed from the ground up to consistently beat the market. So today, we're going to put that promise under the microscope.
Okay, so to really understand the challenger, we have to appreciate the champion. And make no mistake, classic indexing has been the undisputed heavyweight champion of the investing world. I mean, just look at this growth. It started as this tiny idea with just $16 million in 1976 and exploded to a mind-boggling $369 billion just 30 years later. This wasn't just a successful product. It was a full-blown revolution that changed the game for millions of people.
And all of that success is built on one simple, powerful idea: own the entire market and keep your costs as low as humanly possible. But that very simplicity leads to a really tantalizing question. What if you could keep all the good parts of indexing, but just add a little secret sauce to get returns that were better than the market? Now that is the powerful idea we're digging into today.
So to get to the bottom of this, here's how we're going to break it down. First, we'll do a quick refresher on the simple genius of the original indexing revolution. Then, we'll meet this so-called new paradigm and its very big promises. After that, we're going to put on our detective hats and expose something called the hindsight trap,
uncover the hidden costs, and finally, learn why a good plan almost always beats the dream of a perfect one.
All right, first up, the indexing revolution. Before we can really scrutinize the new kid on the block, we have to grasp the beautiful, almost elegant simplicity of the original. And believe it or not, it all just boils down to some surprisingly simple math.
So the whole thing is built on this idea of market cap weighting. Now that sounds super technical, but it's actually incredibly simple. All it means is that if a giant company like Apple makes up, let's say, 7% of the total value of the entire stock market, then the index fund simply holds 7% of its money in Apple stock. That's it. It doesn't guess which company is going to be the next big thing, it just mirrors the market, owning the whole haystack instead of trying to find that one special needle.
And this, right here, is the simple, undeniable logic of indexing. Think about it for a second. All investors, when you lump them together, are the market. So as a group, they have to earn the market's return. But then you have to subtract all their costs and fees. So if you can create a fund that just matches the market and has the absolute lowest possible costs, you have mathematically guaranteed that you will beat the average investor who's getting eaten alive by fees. It really isn't magic, it's just math.
So here's the absolute key takeaway from all this. If you have any hope of beating the market, you cannot own the market. You have to be different. You have to deviate. You have to make a bet. This one single truth is the launching pad for this entire smarter index fund movement.
Which brings us right to part 2. The new paradigm arrives. A new wave of financial entrepreneurs saw this opportunity, this rule that you have to depart from the market to beat it, and they jumped right in. Their pitch was pretty alluring. They would build entirely new indexes from the ground up, designed to be deliberately different and, they claimed, a whole lot smarter.
And here's the core difference in a nutshell. Over on the left, you've got the classic fund we just talked about. It just holds a piece of everything based on its market size. But on the right, you have these new factor-weighted funds that completely ignore a company's stock price. Instead, they focus on specific business metrics or factors, things like a company's total sales or how much it pays in dividends. The bet is that these fundamental factors are a much smarter way to build a portfolio.
And let me tell you, the people promoting these funds were not shy about it. They called their invention a new wave, a revolution, a new paradigm. Some of them even had the audacity to call themselves the new Copernicans of investing. The idea was that just like Copernicus proved the Earth wasn't the center of the universe, they were proving that a stock's price isn't the center of the investing universe. I mean, wow, those are some seriously big, bold claims.
Which of course brings us to the most critical part of our investigation. The hindsight trap. Because whenever you hear claims that are this bold, you have to stop and ask one very simple question. Where's the proof? And the answer to that question is where this whole story really starts to get interesting and maybe a little shaky. You see, the main piece of evidence they present is something called backtesting. It's basically like being a historian with a supercomputer. You go back in time, through decades of market data, and you run thousands of different hypothetical strategies to see which one would have been a winner. It's a process of mining the data of the past. And here's the thing. If you search long enough, you're absolutely guaranteed to find some pattern that looks like a winning formula in retrospect.
And this quote just cuts right to the heart of the problem. Of course these strategies look amazing in the rearview mirror. Think about it. Nobody's ever going to promote a strategy that failed in the backtest. It's like shooting a bunch of arrows into the side of a barn and then walking up and drawing the bullseye around whichever arrow hit closest to the center. You get a perfect record, but it's only thanks to the benefit of hindsight.
And let's be crystal clear. This claim of a new paradigm is one of the oldest stories in the investing playbook. The 1960s had so-called concept stocks. The 70s gave us the Nifty 50. The 80s, it was the January effect, and in the late 90s, who could forget the new economy funds? Every single one of them was pitched as a revolutionary, can't-miss way to beat the market, and every single one of them eventually failed to live up to the hype. History is practically screaming at us to be skeptical here.
This all leads to the most important common-sense question you could possibly ask. If this strategy is so great and so obviously superior, why isn't every smart person with money already doing it? In a competitive market like this one, any real, legitimate advantage gets competed away almost instantly as investors rush in and bid up the prices. The idea that you stumbled upon some secret formula that nobody else has noticed is, well, it's an extraordinary claim that requires extraordinary proof.
Which brings us to part 4, the hidden costs of complexity. Because look, for the sake of argument, let's pretend that these back-tested strategies really do have some small real advantage. The real question is, Does that fragile little edge actually survive contact with the real world? Spoiler alert, it almost never does.
So let's start with the prize they're dangling in front of you. The historical outperformance that these back-tested strategies claim is usually pretty modest. It's typically somewhere in the ballpark of 1 to 2% a year. So for our purposes, let's just call it 1.5%. Okay, now let's watch what happens to that theoretical advantage when it meets reality.
That tiny 1.5% advantage immediately gets attacked from 3 different directions by real-world costs. First, you've got higher expense ratios. These complex funds charge you more, so there goes the first bite. Second, you've got higher turnover costs. More trading means more transaction fees, which takes another bite. And finally, you've got higher taxes. All that extra buying and selling can trigger capital gains, which means Uncle Sam shows up to take the last and often biggest bite.
And, the numbers just don't lie. Look at this. A classic index fund can cost you as little as 0.03%. These new fundamental index funds, they can charge up to 1.89%. That is over 60 times more expensive. That fee, all by itself, can completely wipe out any potential advantage. Then you factor in the higher trading costs and the lower tax efficiency, and the case against them becomes pretty overwhelming. All that complexity comes with a very, very hefty price tag.
So here's the final verdict on performance. Even if you're willing to make the giant leap of faith and assume that the back-tested returns are going to repeat themselves in the future, that hypothetical edge gets ground down to dust by real-world costs. It's a theoretical profit that is almost certainly erased long before it has any chance of ever reaching your brokerage account.
All of which brings us to our final and honestly our most important section. Why good beats perfect. After we've stripped away all the marketing hype and we've looked at the hard, cold numbers, what's the big picture lesson for us as investors?
Well, let's turn to some of the smartest minds in the history of finance. The Nobel Prize winner William Sharpe put it about as bluntly as you can. Betting against the entire market is a hazardous undertaking, especially when you're paying a ton of money in fees for the privilege of doing so. He understood that you aren't just betting against an index, you're betting against the collective brainpower of millions of smart, motivated investors all around the globe. And that is a really, really tough bet to win consistently.
But maybe the most powerful piece of wisdom comes not from an investor, but from a famous military strategist, Karl von Clausewitz. He famously wrote, "The greatest enemy of a good plan is the dream of a perfect plan." And that just hits the nail on the head here, doesn't it? A low-cost, boring, classic index fund is a good plan. It's simple, it's proven, it's effective. Chasing after these complex, expensive new strategies is the dream of a perfect plan, and that dream can trick you into abandoning the very thing that was already working just fine.
And so we end right back where we started, with that alluring promise. That siren song of finding a way to beat the market will always be tempting. But the evidence strongly suggests that for most of us, the wisest move is to just plug our ears, stick to our simple good plan, and not let the dream of some perfect, mythical strategy wreck our perfectly good ship. It really is the ultimate test for any investor. I'll see you next time.
All right, let's talk about the exchange-traded fund, the ETF. It's one of the most popular investment products out there today. It promises the stability of index investing, but with the freedom and flexibility of a stock. But is it just too good to be true? The original creator of the index fund has some pretty serious warnings for us, so let's get into it. Our source material does not pull any punches. It calls the ETF a sort of wolf in sheep's clothing. Wow, that is a pretty serious accusation for something that's in millions of portfolios. So what does that even mean? To really get it, we've got to unpack that disguise. We need to look at the sheep's clothing first. So to see the wolf, we first have to understand the sheep. You see, the ETF was designed to look almost identical to a famously simple and, frankly, revolutionary investment, the classic index fund. Understanding that original, brilliant idea is the absolute key to seeing how the ETF is so very different. The classic index fund was built on this simple yet incredibly powerful idea. You just buy a fund that holds all the stocks in a huge market index like the S&P 500. You keep your costs as low as humanly possible, you hold on to it for the long haul, and boom, you are basically guaranteed to capture the market's return. It's all about investing, not speculating. It's about patience, not panic. Okay, and here is the big twist. The ETF on the surface looks just like an index fund. It tracks the same indexes, it often has those same low fees, but its core DNA, its structure, is fundamentally different. See, it's listed on an exchange, just like a share of Apple or Google, and it's designed to be bought and sold all day long. And that one feature, well, it completely flips the entire philosophy of indexing right on its head.
And this brings us right to the central battle, the heart of this whole explainer, the massive philosophical difference between long-term investing and short-term trading. The classic index fund is the poster child for investing, right? Well, the ETF, it's become the perfect, slick, easy-to-use vehicle for speculation.
When you lay it out like this, I mean, the differences are just so stark. On every single core principle of classic indexing, the ETF kind of goes the other way. Classic funds, they're as broad as possible. ETFs, they're often super specialized. Time horizon for classic funds is forever, but for ETFs, rarely long-term. And costs? That low fee you see advertised for an ETF can be really misleading when you factor in all the brokerage commissions from trading. So what's the end result? With a classic index fund, you're guaranteed your fair share of the market's return. With an ETF that you're trading in and out of, your return is a total mystery.
So let's go back to the beginning. The very first ETF, the Spider, was created in 1992. And it was a brilliant idea. On paper, it had all the makings of a fantastic long-term investment. But that's not what happened. It was immediately grabbed by the very people index funds were designed to protect you from: active managers, hedgers, and professional traders. Get this. Today, around 65 million shares of the Spider, worth nearly $9 billion, are traded every single day. This wasn't an accident. It's what the tool was built for. The Spider was just the tip of the iceberg. The real explosion in ETFs happened when Wall Street figured out it could create a fund for literally any slice of the market, no matter how narrow, how specific, or how risky. And this just kicked off a stampede into these specialized funds. And what a stampede it's been. Just look at this number, $410 billion in ETF assets. A decade ago, ETFs were barely a blip, just 3% of the index fund world. Today, they are a massive force. And that growth, it says a lot about Wall Street's marketing muscle and, let's be honest, our own desire to believe we can outsmart the market. But where is all that money actually going? You might think it's pouring into those boring, safe, whole market funds, right? Well, nope. This chart tells the story. Between 2000 and 2006, a whopping 80% of all the new money flowing into ETFs went into specialized style, sector, and foreign funds. We're skipping the sensible main course to make these concentrated bets on tiny slices of the economy. And what happens when you combine a tool built for rapid-fire trading with a market that's obsessed with these narrow bets? You get a total frenzy of speculation. And the evidence? It's right there in the turnover rate. That's just a measure of how often the shares of a fund are bought and sold in a year. 100% turnover means the average share is held for 1 year. Okay, get ready because these next numbers are truly shocking. Let's start with the original, the S&P 500 Spider. Its annual turnover rate is 3,600%. To put that in perspective, it means the average share is held for just a few days. This is the very definition of short-term speculation, not long-term investing. Oh, you think that's high? Let's look at the ETF that tracks the NASDAQ 100, the Cubes. Its turnover rate is 6,000% a year. We're now in the territory of casino-like activity, something completely disconnected from the patient buy-and-hold world of true indexing. And for the grand finale, a really popular sector fund, the Energy Sector ETF. Its turnover rate is an absolutely astonishing 8,500%. So, is there speculation going on here? Yeah, the answer is a resounding yes. This isn't investing anymore, it's just rapid-fire betting on which way a single industry is going to go. So what's the big deal? What's the consequence of all this speculative trading? Who gets hurt? Well, sadly, it's the average investor. You get hit with what our source calls a double whammy. It's a nasty 1-2 punch that can be seriously hazardous to your wealth. Okay, so here's the trap. First up, emotions. We've seen it time and time again. Investors pile into these hot sector funds after they've had a great run, and then they sell when they go cold. It's the classic, tragic mistake of buying high and selling low. And second, expenses. All that frantic trading isn't free. You're paying brokerage commissions, you're losing money on trading spreads, and you're often paying higher management fees. All of it just eats away at your returns. And here's
Here is the brutal, real-world result of that double whammy. This is not a hypothetical. The iShares Austria ETF, the fund itself, reported a fantastic annual return of 42%. Awesome, right? But because investors jumped in and out at exactly the wrong times and paid all those extra costs, the actual return for the average person in that fund was just 28%. That's a 14 percentage point gap. That money is just gone. It's wealth destruction right in front of us. So, after all that, is the ETF just pure evil? Should you avoid it at all costs? Well, not exactly. The argument here is that it's just a tool, a really powerful precision tool that needs to be handled with extreme care, because in the wrong hands, it can do a whole lot of damage. The author uses this unforgettable analogy. An ETF is like a world-class Purdy shotgun. It's a brilliant, beautiful tool for its intended purpose, say, big game hunting. But that very same power and precision also make it an excellent tool for suicide. The point is, the tool itself isn't good or bad. Its value or its danger depends entirely on how you use it. So, how do you use this powerful tool correctly? The advice is actually pretty simple, and it brings us right back to those classic investing principles. Use a broad market ETF like the Spider for a single big purchase that you plan to hold for decades. And here's the most important part. Do not trade it. Just don't. And if you absolutely must use those specialized sector ETFs, do it sparingly, and only to add a tiny missing piece of diversification to your main portfolio. Never to chase the latest hot trend. And look, this isn't just one person's opinion. Listen to this warning from Don Phillips over at Morningstar, a hugely respected voice. He nails it. He says the potential for harm to investors just goes up and up as these funds get more specialized. In the wrong hands, they can do considerable damage. And let's face it, most of us are not precision investors. And here's another piece of wisdom from Jim Want, the editor of the Journal of Indexes. All these specialized funds, all this talk about enhanced indexing, it's mostly just chasing returns. His bottom line is a classic truth. If you try to beat the market in any way, you're probably just going to get beat yourself by about the cost of trying in the first place.
So we end by turning the author's final questions over to you. Really think about this. Is less diversification really better than more? Is chasing the hot trend a winner's game? Is a strategy built on frantic trading really better than one built on buying and holding for the long run? The author suggests, and I tend to agree, that your own common sense gives you the obvious answers here. Let me ask you a question. What would Benjamin Graham, the literal godfather of value investing, the master of picking individual stocks, what would he think about index funds? You know, a strategy that involves zero stock picking whatsoever. Well, the answer is kind of shocking, and it's been hiding in plain sight for over 70 years.
And we're going to start with this quote from the man himself, because it really cuts to the heart of everything. To achieve satisfactory investment results is easier than most people realize. I mean, that sounds almost too simple, right? Especially coming from one of the greatest financial minds in history. But this very idea, this is the key to unlocking what he really thought about indexing.
So here's our game plan for how we're going to crack this case. First, we'll get a handle on who Graham was and why his opinion is such a big deal. Then we'll dive into the absolute core of his philosophy, this idea that there are two totally different paths for investors. From there, we'll uncover a stunning prophecy he made way back in 1949, see how his opinion of Wall Street got darker over time, and finally hit you with his definitive verdict from 1976. And we'll wrap it all up with a confirmation from his most famous student.
Okay, first things first. To really feel the weight of his words, you have to understand who Benjamin Graham was. He wasn't just some investor. In a lot of ways, he's the guy who literally wrote the rulebook for modern investing.
I mean, his resume is just insane. He wrote Security Analysis, which is basically the academic textbook for the entire field. And then he wrote The Intelligent Investor, which is still considered the absolute Bible for anyone who's serious about investing. Oh, and he also happened to mentor a young Warren Buffett. The guy's whole legacy is built on doing meticulous, painstaking research to find undervalued stocks. He was the original stock picker.
And that brings us right back to the central mystery. It seems like a total paradox, doesn't it? The guy who taught the entire world how to analyze and pick individual companies, what in the world would he think about a strategy that just says, just buy them all, and don't even bother trying to pick winners? It feels like it should go against everything he ever stood for. But it doesn't. See, the answer is hidden in the single most important and most overlooked part of his entire teaching. Graham was not a one-size-fits-all kind of guy. He was crystal clear that every investor falls into one of two buckets, and once you get that, everything else just clicks into place. So the first and by far the most important bucket is what he called the defensive investor. And here's the kicker. He said this applies to the vast majority of security owners. He's not talking about some small group. He's talking about pretty much all of us. He argued that most regular people just don't have the insane amount of time, the relentless drive, or what he called the mental equipment to make investing their full-time job. Let's just put them side by side here. On the left, you've got the aggressive investor. That's who we all think of, right? Deep knowledge, treating it like a business, always hunting for the next big bargain. But for the defensive investor on the right, which is most of us, Graham's advice was the complete opposite. He said they should just be happy with good, solid returns and, this is critical, they must resist the temptation to get fancy and stray from a simple, boring path. So what was this simple path he laid out for the average person? Well, this is where it gets absolutely incredible. Back in 1949, decades before the first index fund was even a glimmer in someone's eye, Benjamin Graham basically wrote the instruction manual for one. He prophesied the entire strategy without even knowing what it was. It all starts with this core belief. Graham was totally convinced that real wealth isn't built by frantically buying and selling, what we call trading today. No, it's built from owning, from holding on to good businesses, collecting those dividends, and just letting them grow over the long haul. I mean, just look at this blueprint he laid out in The Intelligent Investor. He tells the defensive investor to focus on diversification over trying to pick the right stocks. Stick to standard, conservative, even unimaginative investments. Own and hold a big, diversified list of companies, collect your income, and get shielded from the huge, costly mistakes that people make when they try to be clever. Does that sound familiar? It's a perfect point-by-point description of a low-cost index fund. Now, if that 1949 blueprint isn't enough to convince you, the next layer of evidence is Graham's deep and frankly growing disgust with the professional money management industry. His love for a simple, defensive strategy was matched only by how much he hated Wall Street's active management game. And this wasn't some passing thought. You can literally track his skepticism getting harder and more cynical over the decades. As early as 1949, he's pointing out, hey, Wall Street is in the business of making commissions. By 65, he was warning everyone about the hot go-go funds of the era, saying they were creating illusionary profits before they inevitably blew up. And by 1976, he was not holding back. He had some absolutely savage quotes. He called the entire financial industry a huge laundry, where big institutions just pass massive blocks of stock back and forth between each other. It's a brilliant metaphor for a ton of pointless, expensive activity that only benefits the people running the laundry, the brokers and managers, not the actual owners of the assets. He got even more blunt about the odds of success for active investors as a whole. To him, it wasn't a matter of opinion, it was math. Since all the active investors together are the market, they can't possibly beat themselves as a group. So once you subtract all their fees and trading costs, they are, in his exact words, condemned almost by mathematical law to lose. And finally, this one might be his most colorful and dismissive take of all. He called the whole culture of Wall Street a joke that often turns into a madhouse. Now, that is not the kind of language someone uses when they think you should trust that industry with your life savings. That's the language of someone who is desperately looking for a better, saner way. So all of this, the two-path theory, the 1949 blueprint, his disgust with Wall Street, it all builds to this one climactic moment. We're now at the final undeniable verdict, delivered by Graham himself, right at the very end of his life. The year is 1976, and the timing here is just, you couldn't make this up. This is the exact year that the very first index fund for the public was launched by Vanguard. And in that very same year, Benjamin Graham sat down for what would be his last big interview, and they asked him these questions point blank. And here you have it, the smoking gun. The questions and answers are just stunningly direct. Can the average manager beat the market? His answer? No, flat out. He said it was basically a logical impossibility. Should investors just be okay with getting the market's return? Yes. What about that classic excuse from the industry that different investors have different needs? He just called it a convenient cliché or alibi to justify the mediocre record. I mean, it doesn't get any more direct than that. But maybe the most incredible thing he said in that interview was this.
Here is the man who invented detailed security analysis, and he's admitting that for most people, it just doesn't work anymore. He said the game had gotten too competitive, there were too many smart people doing it, he doubted that all the hard work of trying to find bargain stocks could even generate enough extra return to justify the cost. He basically declared his own life's work obsolete for the average person. It's just, wow.
And if, after all that, there is still any shred of doubt left in your mind, we have one final piece of evidence. This is the ultimate confirmation from the one person who knew Benjamin Graham's philosophy better than anyone else on the planet. That's right. The final word in this whole debate comes from his star pupil, the man who took Graham's ideas and became arguably the greatest investor of all time, Warren Buffett. And look at this. Buffett just lays it all out, leaving zero room for argument. He doesn't just say he likes index funds. He says, quote, "My mentor, Ben Graham, took this position many years ago." Buffett is explicitly confirming that everything we've just gone over, Graham's deep belief in a simple, passive, low-cost approach for the vast majority of people, is 100% true. So at the end of the day, we're left with this one giant question. If the founding father of value investing, the guy who literally wrote the book on picking stocks, and his greatest student of all time, both came to the exact same conclusion that a simple, low-cost index fund is the best choice for most people, why on earth is this still a debate? It's a pretty powerful thought to leave you with.
All right, let's get right into it. Today, we're going to cut through all the noise you hear from Wall Street and focus on something that's way more powerful, just simple, undeniable math. We're going to explore how a few basic, relentless rules of arithmetic, you know, the kind they don't exactly print in those glossy brochures, can literally change your entire approach to investing and ultimately your success.
So here's the game plan. First, we'll break down the big problem every investor is up against. Then, we'll get into a surprisingly simple solution. After that, we dive into the math that proves it all, we'll expose why the financial industry feels like it's rigged, and finally, we'll hear from some of the smartest people in the business.
Okay, first things first. Before we can even talk about a fix, we have to be super clear on the core problem, the one thing that trips up almost everyone trying to grow their money in the market.
And this really is the million-dollar question, isn't it? Why is it that most investors, and we're talking about smart, hardworking people, just can't seem to get the returns the market itself is giving out? Why is trying to beat the market for almost everyone what you'd call a loser's game? Well, it pretty much boils down to these two things. Think of them as the two big villains in this story. On one side, you've got expenses, all the fees and costs that the industry charges, constantly nibbling away at your money. And on the other side, you've got our own emotions, which make us do the exact wrong thing at the exact wrong time. You know, buying high when everyone's excited and selling low when everyone's panicking. Now, take a look at this number, 2.5%. That's roughly the annual gap in costs between your average everyday mutual fund and a super low-cost index fund. It's like you're starting a race, but you have to start 2.5% behind the starting line every single year. And you know what? It actually gets worse. On top of those fees, studies show that investors lose another 3% a year just from bad behavior. That's the price you pay for jumping on last year's hot fund or bailing out when things get choppy. So when you put those two together, you're facing a 5% plus hurdle every year that you have to clear just to tie the market. That is a ridiculously hard thing to do.
Okay, so that sounds pretty bleak, I know. It seems like an impossible problem to solve. But the great news is the solution is, well, it's incredibly simple. You don't need a PhD or some secret password. You just need a little discipline.
And here it is. This is the whole playbook. Winning this game really just comes down to these two things. Number one, own everything. Spread your money out so broadly that you don't have to worry about picking the wrong company or the wrong industry. And number two, get your costs as close to zero as you possibly can. That's it. Now let's look at the simple math that makes this idea so unstoppable.
Right. This is where it all clicks into place. And we're not talking about opinions or Wall Street forecasts here. This is just about the simple, undeniable, relentless rules of math that control how investing actually works.
This breaks it down perfectly. Think about where your returns really come from. On one side, you have the investment return. That's the real stuff. Dividends from companies, their earnings actually growing. That's real value creation. Then on the other side, you have speculative return. That's just market mood. It's the daily chatter about what people feel stocks are worth. That changes by the second. But over the long haul, all that speculation just kind of cancels itself out.
The real business results are what's left.
So what's the big takeaway here? It's that real, long-term wealth comes from owning a piece of actual businesses and sharing in their growth. It does not come from trying to guess the market's fickle mood swings by jumping in and out of stocks. You want to be an owner, not a trader.
Okay, but we all know that individual companies can and do go out of business. So how do you protect yourself from picking a clunker? Well, the answer is you don't try to pick winners at all. You just own all of them. Owning the whole market in an index fund is like being on a giant, unsinkable aircraft carrier. Sure, some little boats around it might sink, but the carrier just keeps sailing on. It's the best way to reduce the risk of any one company blowing up your portfolio.
Now, for some really simple but really profound math. Just think about it for a second. All of us, investors, as a group, own the entire stock market. So together, we have to earn the market's return before costs. But we don't get to keep all of it, do we? The brokers, the fund managers, they all take their slice first. So what's left over for us, the investors, has to be less than the market's return. It's a mathematical certainty.
And this right here just completes the whole picture. It's a double whammy. The average investor's return gets hit twice. First, the total market return gets smaller because the industry takes its cut. Then, that smaller return gets hit again by our own mistakes, all the emotional buying and selling. What you're left with is just a fraction of what was originally on the table.
So you have to be asking, right? If the math is this simple and this clear, why doesn't everybody just do this? Well, to get that answer, we've got to zoom out a bit and look at how the whole financial industry is built, because it's often designed to keep this loser's game going. And here are some of the biggest problems baked right into the system. For one, the managers are in control, not you, the actual owner. And what's their biggest incentive? It's usually to get bigger, to gather more assets, because more assets mean bigger paychecks for them, even if your returns are just mediocre. This leads to all sorts of issues. Funds get too big and clumsy to move around, they spend a fortune on marketing instead of management, and they're constantly creating new trendy funds just to sell you on the latest fad.
This quote just nails it. Hoist on its own petard basically means the industry is setting itself up for its own downfall. It's this lethal combination of a broken structure and a mission that seems more focused on gathering assets than on actually helping investors succeed.
Now look, everything we've talked about is based on pure logic and math. But don't just take my word for it. Let's hear what some of the most respected and successful people in the entire world of finance have to say about all this.
Let's start with David Swensen. This guy was an absolute legend. He ran Yale's endowment fund and made them billions and billions of dollars. And he does not pull any punches. He calls the mutual fund industry a colossal failure and says it's based on the systematic exploitation of individual investors. Wow.
Next up, a take from the Wall Street Journal. Holman Jenkins Jr. basically predicts that a day of reckoning is coming for the industry. And when it does, everyone's going to realize that this whole mystique around stock picking is, in his words, a grossly overrated piece of the puzzle. The real key, he says, is cost control.
And then we have Daniel Kahneman, a guy who won a Nobel Prize for figuring out why our brains are so bad at making financial decisions. And what does he say? He admits, the idea that I could see what no one else can is an illusion. So what does this certified genius do with his own money? Yep, he sticks with index funds. And for the final word, we've got to go to the master himself, Warren Buffett. His advice is so powerful because it's so simple. He says that the average person, what he calls the know-nothing investor, can actually beat most of the highly paid pros. And how do they do it? By simply admitting they don't have a crystal ball and just consistently buying a low-cost index fund. It's amazing, right? The moment you admit your limitations, you become a smarter investor than almost everyone else. So we've come full circle. The math is simple, the logic is clear, and the experts from Nobel Prize winners to the greatest investor of our time, they all agree. The evidence is just overwhelming. So really, it all comes down to this one simple question for you. What will you do? Have you ever felt totally lost in the investment maze? Yeah, you are definitely not alone. But what if I told you the secret to success isn't some complex new strategy, but a timeless, simple one? Well, in this explainer, we're going to uncover John Bogle's revolutionary approach to cutting through all that noise and building some real long-term wealth. Let's just be honest for a second. Are your investments more exciting than they are profitable? You know, it's so easy to get caught up in the hype of the hot new stock tip or the next big thing. But is that excitement actually building your wealth, or is it just distracting you from what really truly matters?
John Bogle has a pretty powerful answer to that question. All right, here's our game plan for today. We're going to start by digging into why simple investing is so darn hard to stick with. Then we'll unveil Bogle's brilliant framework for balancing that need for discipline with, a little bit of excitement. Ready? Let's dive in. Okay, first up, the investor's dilemma. I think we all kind of know deep down that a simple approach is probably the best one. So why? Why is it so incredibly difficult to actually do it?
You can see the forces working against us right here. I mean, on one hand, you've got the entire financial industry designed to sell you complex, expensive products because, well, that's where they make their money. And on the other hand, you have our own brains, which are just hardwired for excitement and overconfidence. We love the thrill of the chase. It's this perfect storm that pulls us away from a very simple truth. The brutal, simple math of costs and returns is what really matters in the long run.
So how do we fight back against all this complexity? Well, Bogle's answer is it's beautifully simple. He calls it the common sense strategy. And this is the foundation, the very bedrock of a truly successful portfolio.
And here it is. It's almost shockingly simple, right? The core strategy is just a portfolio made up of two things: a total U.S. stock market index fund and a total U.S. bond market index fund. That's it. Seriously, no frills, no fancy products, just broad ownership of the entire market at the lowest possible cost.
These words from Bogle are pure gold. Look, is this simple strategy going to make you the top performer every single year? No, it's not. But is it going to save you from the literally infinite number of complex, high-fee strategies that are basically designed to fail? You bet it will. It's all about playing a winner's game by simply avoiding the loser's game.
But here's the thing. Bogle was also a realist. He knew that just telling people to be disciplined wasn't enough to fight that natural craving for excitement. So he developed this brilliant mental framework to handle it: funny money versus serious money.
And here's the genius of Bogle's whole approach, laid out perfectly. You create two completely separate buckets for your money. The vast, vast majority, your serious money, is that solid, boring foundation for your future. The money for retirement, for your biggest goals. And then the small remainder, your funny money, well, that's your playground. It's for speculation and excitement.
And this number is the absolute key. Your funny money account, your playground, should never ever be more than 5% of your total investments. Now, why is this so important? Well, it's not just about limiting the financial damage if your bets go wrong. It's a psychological safety valve. By giving that thrill-seeking part of your brain a small, designated space to play, you're way less likely to get tempted to mess with the other 95% that's actually building your future. It contains the risk, and it protects your discipline.
Okay, so now that we've contained our speculative urges and put them in a box, let's focus on the real engine of wealth creation, our serious money. What are the rules for building and managing this unshakable core?
So Bogle's core strategy is that simple two-fund U.S. portfolio, but he wasn't a complete purist about it. He allowed for some sensible additions, like maybe a small allocation to international stocks, but he recommended capping that at 20% of your equity. The key word here is discipline. These are carefully considered additions, not an invitation to start collecting funds like they're baseball cards.
And what about maybe the single most important decision you have to make: how much to put in stocks versus bonds? Well, Bogle offered this simple, powerful rule of thumb: hold a percentage in bonds that's roughly equal to your age. So if you're 30, you'd have about 30% in bonds. If you're 60, about 60%. It's a really straightforward way to automatically decrease your risk as you get closer to the time when you're actually going to need that money.
All right, now for the fun part. What can you actually do with that little 5% funny money account? Bogle gives us a really clear guide for what he considers safe, or at least contained, speculation.
This table is basically your guide to the funny money playground. You want to try your hand at picking individual stocks? Go for it. A truly unique active fund? Yeah, maybe, with some serious warnings about the cost. But Bogle draws a really firm line against something he called closet index funds. These are a big deal. They're these expensive, actively managed funds that charge you super high fees but really just hug the holdings of a cheap index fund. You're paying for a rockstar manager, but you're getting a karaoke track. That's why they get a hard no, along with other high-cost, high-hype products like commodities and hedge funds.
So once we've set up our serious and our funny money accounts, Bogle asks us to just step back and remember the timeless truths that separate the winners from the losers in the long, long run.
These are the fundamentals we just can't afford to forget. Time and consistency,
they're your greatest allies. The risk of being out of the market is far greater than being in it. Diversification, which you get with index funds, is the only free lunch in investing. Costs are the silent killer of your returns, and trying to time the market is and always will be a fool's errand. These are the truths that should guide every single decision you make.
This analogy is it's perfect. We all know the secret to getting in shape, right? The hard part isn't knowing what to do, it's the discipline and the day-to-day execution. Well, investing is exactly the same. The strategy is simple, but fighting that temptation to mess it up is the real challenge.
And hey, this isn't some new idea. Even centuries ago, Ben Franklin understood this core principle. Sure, huge institutional investors might be able to take some wild risks, but for the rest of us, the little boats, our main job is to stay safe, manage our risk, and not venture so far out that one bad wave can sink us.
And if you need one more voice of authority, here it is from the man himself, Warren Buffett. I mean, one of the greatest stock pickers in the history of the world explicitly says that for most people, the best path is not to try and be like him, but to simply buy a low-cost index fund and call it a day.
So Bogle leaves us with this powerful final challenge. Set up your 2 accounts and then, in 10 years, run the numbers. Compare the performance of your disciplined, boring serious money with your exciting, funny money. He was willing to bet your serious money would win by a landslide. And then you have to ask yourself a tough question. Was the thrill of the chase really worth the actual wealth you left on the table?
We're going to end on this, and it's a big one. The Nobel laureate Paul Samuelson wasn't just praising an investment product here. He was describing a fundamental innovation that empowers the everyday person. The index fund isn't just another option. It's a revolutionary tool, as essential to building wealth as the wheel and the alphabet are to building civilization. And that is some common sense worth investing in.